Are you ready to supercharge your wealth and unlock the power of passive income? Welcome to this episode of Dividend Discussion, where we embark on an enriching journey through the realm of dividend investing. Whether you're a seasoned pro or just starting out, this series is a gateway towards invaluable insights and firsthand experiences that will propel you towards financial independence. Join me as we dive deep into the minds of others in the dividend investing space that are eager to share their stories, mistakes, triumphs, and life-changing lessons. In each episode, we unlock the secrets of successful dividend investing, ensuring you can sidestep costly pitfalls and chart your own path towards financial freedom. Sit back, relax, and immerse yourself in this captivating episode of Dividend Discussion. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. I'm your humble host, Troy, and today I have the pleasure of bringing you Rex. Rex, if you wouldn't mind giving yourself a brief introduction and telling the people a little bit about yourself.
Hi, I'm Rex Jacobsen. I'm an accounting professor, and I absolutely love investing. Been doing it for probably over 30 years, and I can't get enough of it. And I do investment research all the time. Even when I think I need to take a break, I go do something, and I start thinking about, what if we try this type of research, stuff like that.
Yeah, I relate to that a lot, actually. Like I'll be just getting done looking at investments, and then I'm like, oh, well, what about this one more thing? And then I look up something else. So I relate to that a lot. Okay, so you said you've been investing for over 30 years. So when did you begin? Do you remember exactly when you began? And then what got you into dividend investing specifically?
Well, I was in the military, and I would drive up to the base with my buddy, and we'd carpool. And he started telling me about his friend who invested in gold coins. And I thought, oh, that sounds pretty cool. So I did some research in it, and I found out that gold historically barely even beats inflation. So I really didn't want to invest in that. And I never did buy any gold coins. And then I bought a book, and I think it was 1991, called Dogs of the Dow. Have you heard of that?
I've heard of it, yep.
Yeah, so it's a method that shows you how to allocate your money to the 10 highest dividend yielding blue chip stocks out of the 30 stocks in the Dow Jones Industrial Average. And then there's different ways you can tweak it so you can be less diversified and just try to maximize the return. So of course, being a new investor, screw diversification. I wanted the absolute maximum return.
Yeah.
So I used that system, and it said, here's the one stock you should buy. And it was Union Carbide, right? I don't even think it exists anymore.
I've never heard of it.
Well, the bad thing about Union Carbide is prior to this, to me finding out that was the number one stock it recommended, Union Carbide had a huge explosion over in India, and it killed lots of people, right?
Oh, like literally an explosion.
Yeah, so
okay.
it was a very frowned upon company. I thought, I don't want to buy that. So I can't remember what I bought, but then like a year later, I went back to see what Union Carbide did, and it was up over like 106%
in a year.
In a year.
Wow.
Right? Because that's how the system works. You buy it for a year, and then you reevaluate the holdings. So I thought, oh, well, I'm a dummy. So I'll follow the system, right, this year, and let's see which stock it recommends this year. And it was Woolworth.
Uh-huh.
Now you're young. Have you heard of Woolworth?
I've heard of it. Yep. I don't. Yeah. Does it trade anymore either?
I don't think so. Someone might have bought it, but it was like Sears before Sears, where it went out of business. Mm-hmm. And so I did buy it. Now this is back when I was an enlisted member in the military. I was making an average of about $11,000 a year.
Wow.
Right? So I invested like, I think $3,000 or $4,000. So, that's like half a year's salary almost, or, 30 or 40%. And it did okay. But doing more research in the Dogs of the Dow, I thought the system didn't really make a whole lot of sense, because a lot of it goes on just the price of the stock. It's not compared to the earnings in the future. It's just going by the price of the stock. And it was a very simplistic system. So I started doing other research into other systems. And in the early days, I tried everything. Growth stock. I even tried shorting stocks, which is insanely risky.
Yep.
because your potential downside is more than you invested, right? I don't know if everyone knows what shorting stocks are, but if you short a stock and you basically sell it before you buy it, and you get $1,000, so your investment is $1,000. Well, if the stock keeps going up, you could lose more than 1,000, right?
Yeah, that sounds like a bad idea.
Yeah, it is. So, and I was successful at that, but the risk was just way too high.
Can you imagine
And
getting a bill from Fidelity?
what's that?
Can you imagine getting a bill from Fidelity?
Oh yeah,
Like that doesn't sound good. You're supposed to show me how much money I have.
I would short stocks for a very, very short time, but I think the most I ever did was like $100,000 of shorting a stock, but it was only for like a day or two. But
Did it work?
even though it was profitable, the risk was too high.
Yeah.
That's one thing that new investors need to understand, is that some strategies have very high returns, but if it's too volatile and you can't stick with it, it's not going to work for you, right?
Mm-hmm.
So that's one thing that people need to understand is volatility. And you can read about volatility all you want, but until you actually experience it with real dollar amounts, especially higher dollar amounts, you don't know how you're going to react.
So there was a, like during this whole like 2020, 2021, 2022, like, cycle we had going on, I know personally a lot of friends or people I have on Facebook that got into investing during that period, similar to myself. But what they did is they were doing the high risk, high returns, the GameStops, the AMCs, the Bitcoin, stuff like that. And to each their own. It's everybody, does what they want. But the thing that they didn't understand is that everybody was happy for the high risk, high return when it was only high return. And they're like, oh, I have a really high risk tolerance, whatever. But then when it doesn't work, a lot of times, like what I want to caution people is a lot of times when it doesn't work, they go out on a limb and say, investing doesn't work. Investing's a scam. They don't want me to win. And I'm like, it doesn't have anything to do with investing, and it doesn't have to do with whoever they is. I'm like, everybody likes it when it works, but when it doesn't work, and when it doesn't work and you're risky, it doesn't work by a lot. It's not like, oh, I bought Coca-Cola and it went down 3% this year. It's like, oh, I bought Bitcoin and it's down 86% this year. Like, that's the difference. So it's like, at that point, if or when it doesn't work, that's when you need to reevaluate your risk tolerance, which is what you're saying, is like understanding like, okay, I like it when it goes up, but I hate it more when it goes down than I liked it when it went up, if that makes sense.
Yeah.
Yeah. So like I tried to tell the people that did that, they were bragging about all the money that they made, and then they were, they're anti-invest now because it ended up burning them. And I'm like, it wasn't investing. It was just your style or lack thereof. It was just like, you're just throwing darts at a board and seeing what happens. Like we had a period, like, I don't know, 12, 18 months there where anything that you bought went up. And then everybody thought investing was easy and stuff like that. And now it's gotten a little bit harder. And well, even right now, like this year to date, I see a lot of people up 30, 40, 50% year to date. And we're back to everybody's starting to say, oh yeah, this investing stuff's not that hard. Well, we're in a really good year. Like the NASDAQ's up 40% right now or something like that. Yeah. Like that's not normal.
Was really bad, right?
Yeah. Yeah.
So they kind of average out,
Yeah, exactly. Yeah. So I don't know. People just need to think of that. Like it's the risk tolerance, and everybody's okay when it goes up. Like everybody can, stomach when they make 40% overnight, but like when it goes down, that's where you need to determine your risk tolerance. Like, can you handle an 80% drop? If not, you're not a high risk tolerance person. Can you handle a 30% drop? That's like a medium risk, I would assume. Like 30% up, 30% down, that's still pretty high. But like, or are you like a small risk? Like, oh yeah, I only want to make, 8 to 12% a year, but I also don't want my portfolio halving in a month either. So like, I don't know, it's understanding risk tolerance, I think, is very, very important. So, so it sounds like you kind of started with the dividend side of things, right? Like, was that on purpose? Because I don't, out of all the inverse conversations I've had so far, nobody started with dividend investing on purpose.
No. When I started, I just wanted to do whatever made the most money, right? Mm-hmm. Which I think is what everyone starts with. And I only started with the dogs of the Dow, which is only dividend stocks, right? Mm. I only started that because that was like the first book I ever read, or one of the very first books I read. And it was understandable. It was easy to do. But of all the different systems I tried, which included options, and the options my best option purchase I ever bought was probably going to be the best investment I ever have. But again, it's just too volatile. I was buying call options. So when you buy a call option, really it's going to be a binary outcome. Either you lose everything or, you're going to make some money. But there's a lot of those call options that just expire worthless.
Mm-hmm.
I've only had one stock that ever went to zero. And I've literally bought probably 3,000 or 4,000 different stocks, maybe more than that.
Wow.
I'm old. I've been doing this for a while. So I came across this one strategy I read about, and then what I did is it's a dividend strategy, buying things like McDonald's and Coke, the typical dividend,
the blue
stalwart.
chips.
Yeah, exactly. And that's what I called it. I called it the blue chip I called it the high dividend blue chip stock portfolio.
Mm-hmm.
And if you want, I can show you the results of it.
Yeah.
And I even started an online investment newsletter, but I never marketed it. So I just I started just for my friends and stuff. But if you let me show you my screen, I can show you the results of how this has worked over the years.
There we go. That's better.
Is that better? All right. So my website is called beatthestockmarket.com. And I told you I didn't market it at all, right? So the way I was able to get subscribers is I just told them, I said, I guarantee you. Now I only did this in the early years. I think like for the first 10 years, I said, I guarantee you I will beat the market. Otherwise you'll get a refund of your subscription.
Ooh.
And during those 10 years, I always beat the market. But I tried other different strategies besides this, but this is the one that was my favorite. I call it the high dividend blue chip stock portfolio. And if I did it now that I've learned more, I wouldn't call it high dividend. I would just probably call it the dividend paying blue chip stock portfolio, something like that. So don't think that all of these are just like high yielding stocks.
I was going to ask what you meant by that. Like, is that growth rate or yield or?
Back then I meant it to be yield.
Okay.
And I never really changed the name, but as the years went by, I started investing more in dividend growers. Okay. That's what I believe in, dividend growers.
Yep.
So it's done 17.6% per year, and the S&P 500 during those years is about 8.2% a year. And I think I started this in 2003. So I don't know if you can see the stocks. These are the stocks I've sold using this system. I bought and hold. And it's gone anywhere from Meredith Corporation, which is a magazine company. And of course, I regret buying that one because it fell 54%. And the best one is Home Depot, 1,700% return. And that's the only one of these that I still hold. And I think that the average stock or the average return of these stocks is, you probably can't see it down the lower right, it says 245%.
Yep. So
obviously this dividend strategy is holding these stocks for multiple years, mm-hmm. right? And this is a I consider this a concentrated portfolio. It's got 17 stocks in it now, including Home Depot. But I personally, now that my dividends are enough that I can live off of them plus some, I want a more diversified portfolio. So that's what I'll share later in our interview is my new strategy for creating a more diversified portfolio. Because 17 to me is too concentrated. Because remember, I plan on living off of my dividends.
Yeah. Well, yeah, at a certain point, like you have to, like I had an interview a while back. I think it was with Kenyon, and he was talking about like he doesn't really diversify, and like it's to each their own. Like everybody has their own strategies, and like and I've struggled with that. Like in my time investing, is just like, okay, like, do I want to try to find 15, 20, 30 stocks that I do have high conviction on? Or do I want to try to find, 10 with like core position? Because I've heard like the core and the satellite portfolio where you have like 3 or 4 that make up like 50%, kind of like Warren Buffett, where Apple makes up 50% of his portfolio. Then he has a bunch of other big companies and then like a bunch of small ones. So it's kind of like a solar system almost. So yeah, I mean, everybody has their own strategy. That's one thing I love about these interviews is hearing. It's almost like an episode of Shark Tank where everybody I talk to, like everybody likes their own strategy because most of the times they thought about their own strategy. So it's cool to like almost hear everybody that I speak with pitch their ideas of like, hey, here's my returns. Like I do the same thing when I talked about my 3 simple metrics that I use. Like I don't care if people use it or not. Like I'm going to use it. But it is almost me pitching it. I'm like, hey guys, this doesn't need to be complicated. You don't need to look at price to book and price to sales and all these different ratios that some of them matter, some of them don't. Like you don't need to look at all that. Here's metrics that I use. Everybody understands them and they're real simple. So, so is this the 17.6 that you have on there? Is that from 2002 to today, or is this like old data?
No, this is through last week.
Okay, that's really cool.
It's through Friday, basically. I guess 2 days ago.
Yeah. I like that. That's pretty impressive.
I think it was May 2003, something like that.
Yeah.
But you were exactly right. I'm not here to tell anyone this is the system that's the best, or that this is the system that everyone needs to use, because there's lots of different ways to successfully invest, but you have to find out what works for you. Mm-hmm. Now, my new system that I've been developing and using with real money, and I'll show you the results of that, is very diversified. But if you're the type that is, and in that system, I use analysts that I trust to do the analysis for me. But if you're the person, and a lot of the people are like this, they want to analyze every single company themselves. Mm-hmm. Well, they wouldn't be able to use my system, this other more diversified system, because it would be just too much research for them.
Yeah.
So, it depends on what you want to do. There's lots of different ways, but you just need to make sure that you're not trying to use someone else's system that is not a good fit for you, right? If someone is going for high risk all the time and, you don't have a high risk tolerance, that's not going to work for you.
Yep. Yeah. I agree.
I don't know. Have you seen this? I'm going to change the slide here.
Yep.
Have you seen this study showing dividend paying stocks versus non-dividend paying stocks?
Yes, I have seen this study. I also was thinking like this is, if I can get ahead on the channel, I want to do like some of the videos I want to put out, like the impromptu videos are more like deep diving just into like the analytics of it, just because I'm that type of person. I wanted to know of the stocks that raised or decreased their dividend, because I see that we have dividend growers, payers, cutters, and stuff like that. I was really curious, and I might just have to start it next year because we're already, 8 months into this one. I want to see what the average yield of, like, basically find out the yield and the average dividend growth percentage of each company that raises, and then same thing of the cutters, because I'm willing to bet I never see cutters of companies that are paying, 1, 2, 3, 4% yields. It's always the one, oh, they made a 26% yield. Of course it got cut. So like, I really want to see that and just start saying, okay, look, this company is a 1% yielder. That might be really low, but these 1% yielders are averaging a 13% dividend growth rate. And these 2% yielders are averaging an 8% dividend growth rate. Like kind of figure out like, cause I feel like I can do another video off of like formulas for that. Like, okay, on average, if you have a 1% yielder and it grows by this, if you need your money by this time, like you can figure all that stuff out. So that kind of ties into this chart, but I have seen this before.
Yeah, this chart, and if everyone can see the link down below, they seem to update this every year. So of course, I don't know when you're going to be watching the video, but you can always go here for the most recent data. Now I have a bone to pick. Now, since I'm an accounting professor, and my job is communicating things, I have a real big bone to pick with this, the way they lay out the chart. So I change it. I'm going to go change the slide, right? So this is the same data as before, but I'm just laying it out differently. So there's 2 types of stocks. They either pay dividends or they don't pay dividends. Mm-hmm. So dividend paying stocks and the testing period was 1973 to 2022. Of course, not this year yet because it's not over with. So dividend paying stocks averaged 9.18% per year total return with a beta of 0.94. So a beta of 1 is average. Beta is measuring volatility. So these stocks have a little bit less volatility than the average stock. And it shows you the standard deviation, which is another different form of measuring volatility. And then if you compare this to the non-dividend paying stocks, those average negative 0.6%, right? With much more volatility. The beta is 1.22, which means I think the way you explain that is it's 22% more volatile than the average stock.
Which isn't worth it if you're losing money. Like,
no, but you know what? Here's what happens. People gravitate, especially newer investors, they gravitate to the non-dividend paying stocks because they're hoping for the stock that's going to grow up 10,000%, right? So the dividend paying stock is usually a profitable company that's been around a while. And because the only way you can pay a dividend is if you're profitable, if you can consistently pay it, if you're profitable and you're more of a mature company. Smaller companies don't want to pay a dividend because they want to take that extra cash and then grow the company. So people are, you know, how people always talk about someone won the lottery. Yeah. That's what they're trying to buy with these non-dividend paying stocks. Not everyone, but a lot of people are, because they heard of some guy who bought a stock, some guy or gal bought a stock and it was up, you know, 20,000%. So that's what they're shooting for.
Yeah.
But if you're going to do this diversified over a long time, chances are the dividend paying stocks are going to be better. So then you take the dividend paying stocks, you can divide them into three groups. Those that grow their dividends, and that just means they've increased their dividend that year.
So think of the kings and aristocrats.
Yeah. Those that don't change their dividends, and then those that cut or eliminate the dividends. So the ones that do the best are the ones that are growing their dividends, 10.24%. The stocks that pay a dividend but don't change it average 6.6%. And then those that cut or eliminate the dividends, only 3.95%. So this is why I prefer dividend paying stocks. Their volatility is lower, which means it's much easier on you emotionally to hold these stocks. And the returns are actually higher. I mean, it's not often that you can get an investment that pays a higher rate of return or has a higher rate of return with less volatility.
Yeah. I like those chart, like, and it does look a lot better on the one that you made versus the one that we've all seen.
They don't lay it out very well.
Yeah.
And then they throw the S&P 500 in there too. And, you know, a lot of new people look at that. They don't realize that the S&P 500 is going to consist of both dividend paying stocks and non-dividend paying stocks.
Yeah. So. Yeah. It goes back to the risk tolerance and stuff. Cause you do have your non-dividend paying stocks that, you know, turn into something, your Teslas, your Netflix, your Facebook, or Meta or whatever, but like all those, but then, and it's not, what you're saying is that it's not a guarantee either way. Like there's never a guarantee in investing regardless. So like for example, Disney was I think they were an aristocrat at one point, then COVID hit, they had to shut down their parks, they cut their dividend. So it's not always like cut and dry, like AT&T. It's a stock I always pick on. AT&T, they haven't made any money forever, and they're in tons and tons of debt, and they keep going in further in debt, and their yield wasn't a result that they were doing well and raising their dividend. Their yield was a result because their stock price kept falling. So as their stock price kept falling, of course they have an 8% yield because they haven't grown in 20 years. So like come to think of it, I can't name a stock in that middle category that no change the dividend. I don't know any stocks, at least off the top of my head, that like pay $1 per year, like all the time.
No, I think the study is just looking at stocks in a given year. Did they grow it?
Oh, okay.
Not change it, or did they cut or eliminate it?
Okay,
I think that's how we categorize them.
Yeah, I'm sure there are stocks that have, you know, paid for, or like they might not do it like forever, like in perpetuity, but like I wonder if there were stocks that were like, hey, you know, we've always paid 80 cents per share per year. We're not like an increaser, but we are consistent. And then maybe they, you know, increase their revenues to a certain point, and then they're like, okay, we're going to pay 90 cents per share per year now. But, I'm the dividend paying, growing dividends type of guy too. So like it's cool to, you know, pat myself on the back here and see those good numbers.
Yeah. I think historically the average dividend growth rate is like 5.5 or 6%, which is awesome because that's faster than the rate of inflation.
Yeah.
inflation historically has averaged about 2.99%.
Yeah, which is weird. I don't understand how the Fed, where they pull this 2% number from. Like historically, we haven't been at 2%.
Oh yeah, yeah. Like 4 years ago, 3 years ago, it was really low. It was lower than 2%.
Well, yeah, and I mean the average is almost basically 3%. So they're just like, we want to get back to average inflation of 2%. I'm like, when's the last time we had a sustained period of 2% inflation?
Oh yeah, just my opinion. We're not going to get back to 2%. We might get down to about 3%,
which is around average by the sounds of it.
Sustain it. I'm talking about being able to sustain it. We might dip down to 2%, and then it'll probably pop back up. But the supply chain screwed up inflation, but they're slowly getting fixed, which is why inflation is falling right now.
Hey, it's transitory.
Well, yeah, it wasn't as transitory as they thought, but it's dropped significantly, right?
Yeah, I think they're doing a good job, and it's that goes to show, like, the point of bringing that up is, like, I know a lot of people. I watch CNBC every morning, but like I don't watch it for, like, when they start like doing the predictions, like, oh, here's so and so from this firm, like they are predicting the recession's going to be in 2024. I'm like, they said the same thing this year, and then they were really wrong. I'm like, I posted videos talking about stock price doesn't matter, and that wasn't clickbait. I genuinely believe if I identify a company that meets all their criteria, which my criteria is simple. But if it meets my criteria, I might not put 100% of the money I want to put into it, but I'm starting my position when I identify it. Because there are people in our group that are on that dividend growth investing group on Facebook that literally have told me that they never got to buy Apple or Microsoft because they were waiting for a certain price, and it came within 20, 30 cents per share of that price, and they never ended up buying it. I'm like, so instead, like, you tried to save 20 cents and you lost out on hundreds or 1,000% gain because of 20 cents. I'm like, how does that, like, I would be sick.
Yeah. A lot of people rely on PE, the price to earnings ratio, too much, because usually they're using the price to earning of the last 12 months. Mm-hmm. But the stock market is always looking forward, right? Mm-hmm. If the stock market did not look forward, you could just buy a toy company in like November, knowing that all of a sudden they're going to have a huge amount of sales in December. But that's not the way it works. Everyone on Wall Street is looking into the next, 6 to 12 months. How is that company going to do? So you can't be, in my opinion, you can't just rely on something that's only looking at the past 12 months.
Yeah. Well, you have like, I've brought up price to earnings before, because when I first started investing, that seemed like one of those can't miss numbers. Like they have the price, like they're like, oh, the PE, this makes sense. But like, not only is each sector PE, like the golden rule for what the PE should be in each sector, like the difference between a utility PE and a technology PE is vastly different. And then you get into these companies that just always trade at a premium. If you're waiting for Apple, or like, I'll use one I know, for example, Costco. I bought Costco. That was when I sold my NVIDIA stock, which, probably shouldn't have done that, but here we are. Sold my NVIDIA stock, took a 55% profit, bought Costco, and also balanced out the rest of my portfolio. And Costco looked expensive. I'm up like 14% on Costco in the last 2 months because it never seems to go down, but it's always expensive. If I were to wait for Costco to be at a perfect price, I never would have bought it. So
I agree.
Yeah, like you have certain companies that you just have to, like Costco, not going anywhere. Apple, Microsoft, Visa, those companies are at a premium, and they're at a premium for a reason. When you go to a car dealership, if you want to buy a Kia or you want to buy a Rolls Royce, there's a difference for those. They both get you from A to B, but there's a premium on certain companies than there is on others. It's just how it works.
Yeah, that's the problem that people who only invest in really high yielding stocks, they don't understand. You want something has a good future. You don't want to be buying the best company in a crappy industry that's going to go out of business, right? That's like in that previous slide I showed you. The worst stock in that investment newsletter portfolio I had was Meredith. Well, what do? They publish magazines, so you can see why they're doing poorly. So you don't want to be buying something that's in a dying industry, right? Yeah. Just because the yield is high, or just because their price to earnings for the past 12 months is low, because earnings might be decreasing in the future. And then I have to throw this in too about you have to be careful with PE. And I'm not saying don't use it,
Yeah.
but you have to be careful because so PE is price divided by earnings. Well, as an accounting professor, I can tell you that companies can easily manipulate earnings, which is just basically profit, right? They can manipulate that easily on paper to make it look better than it is. So something that's much harder for them to manipulate illegally is cash flow. So if I was going to choose just one metric, I would use price divided by cash flow from operations rather than PE. And you want to use, you don't on the bottom, you don't want to use just cash flow because you want cash flow from operations. There's three types of cash flow. Cash flow from operations, that means running your business. Cash flow from financing, which means you could be issuing bonds, right? But you're getting all this cash. Well, you don't want that type of cash flow. And you could have, there's also cash flow for investing activities. You want your company to be investing in itself, right? As opposed to like selling its factories. And that's one way that they could be getting cash flow. Well, you don't want your company getting its main source of cash being selling off its factories because that's not sustainable. So that's why you want to use cash flow from operations.
Yeah. Yeah. I've heard a lot of people use the cash flow and stuff. And there's a bunch of YouTubers I watch. Joseph Carlson's one. I really like him. He dives pretty deep into all that kind of stuff. And like we were saying, I don't know, 20 minutes ago, it's all personal preference. The biggest thing is not only making sure you have a plan, which a lot of people, me included, when I first started, I didn't have a plan. I was just buying stuff. So having a plan. And then the second part of that is having a plan that you understand. I could argue the third part of that's having a plan that you understand, and having a plan that meets your risk tolerance and your time frame.
And one that you can follow, right?
Yeah.
Because there's a lot of no investment strategy works all the time. No system beats the market all the time. And I got lucky for those 10 or 14 years, whatever it was, that I beat the market every year. So you have to realize that there's going to be down years to whatever system you're using, right? Like for example, dividend strategies tend to outperform during bear markets. But when the market goes crazy, a lot of times the dividend paying stocks are going to trail. Well, it's not going to work every year. So you have to be able to stick with your strategy. And one other reason I like investing in dividend paying stocks is you can earn a lot of money in qualified dividends and pay zero taxes.
Yeah, it's kind of weird how that works. Like it's pretty amazing.
I'm married, so I can get I can earn $116,950 a year in qualified dividends. And if that's my only source of income, pay zero taxes. I don't know about most people. Even though I live in an expensive city, I can easily live on $116,000 a year.
Yeah. Well, yeah, and especially like if you end up setting everything up right, and then by the time you not only are your dividends qualified and you're married filing joint, so you can have a higher taxable income, then you have the standard deduction, you have all those things. If you can get it to the point where your cars are paid off and your house is paid off, which is everybody's first and second highest expense, everybody's like, especially for me, I want to retire early at 50. So like everybody's like, oh yeah, you have to make sure you account for healthcare and this and that. I'm like, yeah, well, if my house is paid off, my car is paid off. If my biggest expense is healthcare, that's basically my only expense. I'm paying utilities, taxes, like on, my property tax and school tax and stuff like that. But like those are basically all my bills. And I'm like, I don't know about you, but I don't make $116,000 right now. And if I had $116,000 and it was at 0% tax, that's a bit like right now, I don't even know what bracket I'm in, like 22, 27%, something like that. And I'm not even making that much. So I'm like, all right, well, imagine making like double, triple what you make and not paying any taxes on it. Like it goes a lot further because you're keeping all of it. So,
yeah. And trust me, as a professor, we don't make much money.
Yeah. Well, you're just smart with it. And that's what's really important. Like I see so many people talking about, oh, I need to find ways to make more money. The easiest thing you can do is find ways to save more money. Like find out when I got, quote unquote lucky, but I learned about this whole money stuff during COVID. And then I also heard everybody talking about home interest rates going down and refinancing and stuff like that. So I went from a 4.625% mortgage for 30-year fixed to a 2.75%. And I'm not paying a dime on that early because 2.75, like we just found out, the price of inflation over the long term is 2.99%. My interest rate is lower than the long-term rate of inflation. I'm basically borrowing my money for free. Because like right now, if I'm paying, $800 a month for my mortgage, $800 in 2023, in 30 years from now, in 2053, $800 is going to be like $200.
Yeah.
So like so that's something I just learned over time. And, you just have to be smart about figuring out ways to reduce are you and the wife or the girlfriend or whatever, are you guys paying for a cell phone bill and 2 separate bills? Would it get cheaper if you combined your bills and you guys run the same plan? Can you save $10 a month? Just little things like that. Being savvy with the money that you do spend. And then once you are, 100 or really efficient, 100% efficient or really efficient with the money that you do spend, then you can look into, okay, like now I reduced how much I'm spending per month, from $1,500 a month down to $1,200 a month. Now let's see if I can go from making $2,000 a month to $2,500 a month. And then you work on both ends. So.
And when you get a raise, don't spend that raise.
Yep. Right? Lifestyle creep is real.
Yep.
Yeah.
Put that money away. Really, you and I obsess about investing, but the true path to wealth starts with personal finance, because you can't invest unless you're saving something, right?
Mm-hmm.
So really what people need to do is look at their expenses, try to minimize that. And if you can, try to maximize your income. Mm-hmm. I mean, it's really simple. It's not very complicated, but the problem that most people do is they want to be like the neighbor. Well, the neighbor bought a new $50,000 car. I think I should have one too. Yep. Well, why? Why do they think they don't want to look poor or whatever? Their self-esteem is so low that they need to puff themselves up to other people. But when you're age 65 or whatever age you're going to retire, who cares what those people thought back then? You should have bought a used car and just lived with it and saved the extra and invested it. And you don't have to be like us to try to pick stocks. You can just do a simple ETF like VU.
Yep.
And then just you don't have to worry about picking stocks.
Yep. I've said that in a bunch of my interviews. I'm like, if you watch this interview and you get inspired about like, oh, what investing could be, literally start with a very whatever you can afford in VOO and let it do its thing. And then what happens is, worst case scenario, you never get an interest with it. And then you're just building money through VOO and that'll work for you in the long run. Best case scenario, you do get an interest in it. And then you can start learning little things. That's what happened to me when I got my first free stock. I got a dividend. Well, if I would have never got my first free stock, I would have never got that dividend. And I would have never asked myself, what the heck's a dividend? Why did SiriusXM pay me a penny? What did I do to get that penny? So like I just started looking little things like that and it snowballs. But like I said, worst case scenario, you never let it snowball. It never interests you that much. You're still putting money in something that is going to grow for you exponentially over decades. And then you'll have money for yourself when you're done.
Yep. And now your portfolio consists 100% of SiriusXM stock.
Yeah, right? Yeah. Now I only own SiriusXM. That'd be something. That'd be a good YouTube video. Okay. So we went on that one. So next one is, what would you say your biggest dividend mistake that you've ever made, and what lesson did you learn from that?
I kind of mentioned it before. It's better to own a thriving business with a smaller dividend yield, in a growing industry, rather than a slower growing company and with a high yield where it can't grow much, right? And like I said, Meredith, the magazine company, that's a great example. It's not, you need to buy something that's going to have a future and can grow, not just sit there and stagnate or possibly go away. That's why I also shy away from mall operators, right? There's some mall operators that dividend people love to buy because it's got a high dividend yield. But I don't know about you, but our malls are not doing well. They might have to transform into apartments, and that's really expensive to do. So that's probably the biggest dividend mistake I ever is making sure that the company you're going to invest in has a future and is in a growing industry. Don't buy just on high yield.
So would the modern, I'm curious your thought, because I saw this on your list. Would the modern example of Meredith possibly be Altria?
I'm going to go back to my list. You guys can't see it. I want to go back to my list because Altria was one of the best stocks in that portfolio. I sold it after a 428% gain. And I believe Philip Morris is in the list too. Yes, 223%. So they did really well back then, right?
Mhm.
Starting around 2003. But I'm shying away from them now, even though their cash flow is fantastic, because everything is pointing to those industries just slowly fading away. I mean, there's even legal things,
With the jewel.
legal. Yeah. Well, also, governments are trying to make it harder on those companies to exist because they're killing off their customers. So yeah, I'm avoiding those for the most part. I believe I have a very, very tiny holding of Altria Group because it came up in my system, but I'm not going to be adding to it. And
Because it fits the characteristics of what you were talking about. Like, it used to be really popular. I mean, I know Altria actually outperformed the market over the last 10 years, but like what you're saying is like trying to evaluate, you're not putting money in it to get the 10-year prior performance. You're putting money in it for the next 10 years. So like over the next 10 years, yeah, Altria has a really good dividend growth rate, or not a dividend. They have an okay dividend growth rate. They have outperformed the market, and they have a dividend streak they've been paying for a long time. But when you ask yourself 10 years from, like over the last 10 years, everybody's seen how, I personally know like 3 people in my life that still smoke. I feel like 20 years ago or like 10, 15 years ago, I felt like I knew 3 people that didn't smoke. So like, what does that look like 10 years from now? How many people smoke 10 years from now? And like, when that's most of what they make their money on, like that could be the next company that was the bee's knees. And now here we are.
Yeah, not good unless you have some inside knowledge that they're going to go a different direction, that's something that is sustainable. But I think just tobacco itself is not sustainable. So that's a good point of yours. I think that's kind of an example of maybe this is the Meredith of the future.
Yeah. I was just thinking that because I know, like I said, I've seen a lot of people, people don't invest in stuff like that because they consider it like a sin stock. And then the other thing, I mean, what you said is really messed up, but really true about like literally their best customers are the ones that they don't keep because they, die of lung cancer or whatever. So they're literally killing off their own clientele. So like you can only have your customers for so long.
I bought those stocks in the past because I thought they would be a good investment, and they did turn out to be a really good investment. So I'm not a moral investor. If a company is like, if I thought the cigarette companies were going to make a lot of money in the future, I would still invest in them, even though I think smoking is dumb, but that's a personal decision. And this is kind of sad to say, but the perfect company is one where the customer is addicted.
Mm-hmm. Yeah.
And alcohol and cigarettes are 2 examples of those, but another example of those are any of these social media companies.
Yep.
People are addicted to their phone. I mean, you could say Apple customers with an iPhone are addicted, and I'm addicted with my phone. It's right here. So yeah, that's the best type of companies where you got addicted customers. It's kind of a sad state of affairs.
Yeah, addicted, or there's just a moat where it's almost impossible not to use, which is why I own Visa. Because like, I don't know, if you check your wallet right now and you have a debit card or credit card in there, I'm willing to bet it's a Visa card.
Wait, but they're not paying an 8% dividend.
No. Yeah, I'll take my. I think they're at like a point. What are they? 0.5, 0.8, something like that. They're under a 1%. But I'll take my 15% dividend growth rate and capital appreciation.
That's right. So, and I'm sure there's some people watching this who will say, well, there's no way I would ever buy a Visa, something that's has a yield of 0.6. Well, okay, so let's look at that Home Depot example of mine. I bought in 2003. The dividend was 24 cents per year, right? And I still recommend it to my subscribers. That dividend, 24 cents, is now $8.36. So it was yielding
in 20 years.
It was since 2003.
Yep.
It was yielding 0.8% then, right? But you know what the yield is on the original investment?
Like 50%.
29%.
That's ridiculous. Yeah. Could you, could you make it on 29% yield? I think you could.
Can you buy a bond that's going to be paying you 29%? Can you ever buy a bond that's going to increase its interest? No, you can't. That's not how bonds work. Of course, stocks tend to be riskier than bonds, so you would want a higher return. But that just shows you the example of being patient and letting your company grow and grow its dividends, hopefully, so that you can have a much higher income from dividends in the future.
Yep. I mean, I preach that on the page all the time. And then like in the groups, people will post and they're talking about, here, I almost don't care. I actually had somebody comment on one of my videos the other day and he told me how old he was and like what his plan was. And I was like, the age is almost irrelevant because like, that's another thing that's hard with like the demographics of my YouTube channel is I can't really do anything with the age. When it's telling me, 64% of the people that watch your channel are 21 to 30. I'm like, that doesn't mean anything to me. Because like, just because you're 30, you could be investing for 6 days and be 30, or you could have been investing since you were 16 and be 30. So like, it doesn't like, there's no like that. I can't get anything from that. So I don't really use it, but like the age of when you plan to use the money. And this is what I talk about in the comments all the time is like, there's all these people that have 5, 6, 7, 8, 9, 10% yields. And then they're like, I'm 35. I plan to retire at 65. I'm like, okay, do you think your 8% yield is sustainable for the next 30 years that you're going to be investing? Or would you rather buy a Home Depot, a Lowe's, a Starbucks, a Visa, a Microsoft, not AT&T, an Apple, stuff like that, where the yield right now is very small, but between the capital appreciation, the dividend growth rate, and the streak of them constantly growing that dividend, it's going to be far higher than what you would if you would just keep that 8%. Like, yeah, the first 10 years, you're going to make more in dividends than I will. But the next 50 years, I'm going to make way more. I'm going to double, triple, quadruple you. So that's just one of the things I just try to like, and it's really hard because like at the end of the day, one of the things I love seeing with people that have invested for a while, just like yourself, is I can't wait until I've had these stocks that I've had for decades. And then I can look back and be like, I'm up thousands of %. Like that's really like right now, like I have a couple that are up, 30, 40, 50%, and I've held them for like 2 or 3 years. Like that's really cool. But like, I can't wait until I've had them for 10 years, 20 years. And I'm like, man, look at this. This stock's doubled under my watch. Like that's really cool to me.
Yeah. Yeah. You remember, like I said earlier, you want your dividend income to grow. And if you're just buying these high yielders, they're not going to grow their dividend. I mean, they just can't grow their dividend that much. And a lot of them are yield traps and they're going to have to cut their dividend.
Yep. And like, that's the worst case scenario. What happens if you are, say it's, I forget when AT&T cut theirs, say it's 2022, 2021, something like that.
I think so. And by the way, that was you could tell that was going to happen.
Yeah. Yeah. It was super predictable. Like their debt has been the only thing increasing out of the whole company. The only thing increasing is their debt. And their yield, which is, yeah, that's not a good, I'm not a math major or anything, but I don't think that's good. But like, so like, imagine this, imagine you work for 40 years, you're putting money back in, you're at a point where you're putting money into AT&T and you're like, finally, today's the day I look at my dividend portfolio, I'm making $100,000 a year, I can finally retire. And AT&T knocks on your door and they won't really do this, but imagine this, knock on your door, but hey, we have to cut our dividend by 50%. So you went from making like, obviously this is saying that you're 100% invested in AT&T, but if you buy these kinds of companies, this happens. I've never experienced the dividend cut, and I hope I never do, but I think by buying the companies that I buy, I don't think I will, because I'm buying companies that, like, one of the metrics that I do want to add to my big 3 that I look at is the payout ratio. Because at the end of the day, if the payout, like, I want companies with a payout ratio under 40% preferably. Because if I want these big, massive dividend raises that I'm getting, like a boss knocks on my door, he's like, hey, you've done a great job not working for us, here's a 10% raise. Like, I want them to be able to constantly do that year after year after year, and they need a payout ratio. They need to have enough money to constantly not only operate their business, but pay me increasing amounts of money.
Yeah.
So that's if I had to add a 4th thing to my 3 big things that I look at, the payout ratio is the one I'm going to be looking at going forward. I'm like, okay, I like these 4 stocks. Let me look at the payout ratios of all of them. These 3 are these are high. This one's at 15%. Let me jump in that one.
Yeah, and preferably you want to use a a payout ratio that's looking in the future, right?
Mhm.
I mean, if you're looking at just the past payout ratio, what happens if the company is coming up to a bad year? And if you use the average earnings estimate of all the analysts, because there's good analysts and bad analysts, but overall they can tell you the general direction of the earnings for the next 12 months. That's one of my criteria is I look for a forward payout ratio that's low.
Yeah, I like that. So that kind of feeds into our next question. So how has your investing style changed from when you started until now?
Well, because I plan on retiring soon and living off my dividends, I want my portfolio to be very diversified, right? So when I first started, well, like I said earlier, when I first started investing, it's like, screw this. I want whatever's the best. So I'm going to buy that one single best stock and I'm going to put all my money into that one stock. Well, not anymore.
Yeah.
I need to have something very diversified so that when one industry hits its slump, the other industries are doing well. So that if some have some zero dividend growth or cut their dividend, because when you're diversified and over time, eventually that's going to happen. You're going to come up with a company that will cut their dividend or even eliminate it, like in Disney's case.
Mm-hmm.
So that's what's changed the most now is I'm less risk tolerant. So I want to be more diversified. And also by being more diversified, it's easier just to have confidence in your portfolio.
Mm-hmm.
You don't have to worry. Like if you have only 10 stocks and one of your stocks is really releasing the quarterly report today, you got something that you better be watching because there's 10% of your income relies on that report.
Yeah. Yeah. I do think, so it is risky, but I think that like if you have a fewer amount of companies to grow your wealth, obviously it depends on it working, but if you have fewer amount of companies to grow your wealth, I think more companies would be required to preserve your wealth. For exactly what you're saying. If you own, let's just say 100 companies for easy math, if you own 100 companies and they're all paying out 1% of your total dividend income, and one of them just say eliminates, you go down from 100% to 99%. That doesn't notice anything. But like if you had 5 companies and one of them's AT&T and they're all paying out 20% and AT&T cuts theirs in half and say one of them was Disney and Disney eliminates theirs, then you're down 40% on your income and you're just like, what do I do now?
Yeah.
So like I do think, so I mean, but that all depends. Like I said, I wouldn't, unless you're selling everything and putting it in VOO, then you're diversified into 505 different companies. But like, other than that, like I think that being concentrated for growth might not be a bad idea. Obviously, but you need to have that conviction in the stocks that you're going to pick are going to do well. Cause if they don't, then you're not going to grow nothing. But like, yeah, I don't know. Like, I feel like, would you rather, like I said before, would you rather try to, have 100 companies and hope that 20% of them work? Or would you rather, to me, it's the same thing. Would you rather want 100 companies and hope 20% of them work? Or would you rather own 5 companies and hope that one of them works?
Yeah. As far as diversification goes, it's a balancing act, right? You don't want to have too many companies that you can't follow them for whatever your system is doing, but you also don't want to have it to be too small. I mean, if you have a 3-stock portfolio and one of them tanks, your portfolio is really in trouble.
You better hope you have the NASDAQ and the other 2 spots.
Yeah. You also want to diversify. You also want to diversify across different sectors. I know a lot of people that are 100% in technology. Mm-hmm. And well, yeah, that's great when technology is flying high, but those people that were in 100% tech last year,
you didn't see as many YouTube videos from them, did you?
What's that?
I said you didn't see as many YouTube videos from them when they're last year, did you? That's weird how that works.
It's weird when their strategy is not doing too well. You don't seem to hear from them. I wonder why.
Weekly updates when I'm doing well. Like we'll do quarterly updates when I'm not doing well. Yeah, that's weird. Yeah, I don't know. Like I do a monthly update just mainly because 1, it takes me a lot of time to do, and 2, my investing style is really boring. Like I just buy the same companies, a little bit of dollars every day. Like it's nothing entertaining that you guys would want to see. So I just, once a month, here's what I did.
Consistency is the key, even if it's small dollar amounts.
Yeah. Yep. Okay, so you said that you plan on retiring early. So what are do you have any goals that you hope to accomplish with dividend investing by the end of the year? And what are your long-term goals with dividend investing look like?
Well, originally my goal with dividend investing is to have enough dividends to live off of, called a crossover point. And I've reached that. And then my next goal was FAT FIRE. So FIRE stands for financial independence, retire early. And the FAT means you not only meet your expenses, plus you have a lot of extra. So I've reached that point now, which is why I'm going to retire soon. This might be my last year of teaching. And then what am I going to do after that? Well, I'm going to live off my dividends.
Whatever you want. That's the answer.
Yeah. But because I'm a degenerate investor, what I'm going to still do is I'm going to still share my investment analysis. And I want to do this. I want to start doing this on YouTube to help young people who are just starting out with no money, because it's going to be free to watch the videos on YouTube. I'm going to try to give them a list of dividend stocks to pay. And I might do this every week because that's what I'm doing now. So my accounting students, a lot of them don't think you can create a good portfolio on a small amount of money. Well, when I was in the military as enlisted before I got my degree, I was averaging anywhere from $10,000 to $11,000 a year. And I started investing $50 a month. So I want to show my students that, yeah, you can build a portfolio on $50 a month. So here's what I've been doing since 2022 is each week I take $12.50 and I buy 10 dividend paying stocks.
Jeez.
Yes, that's a very small amount, right? But the portfolio's done really well. And it's, see, I have the slide here somewhere. I guess I could share it now. Let's see here. Yeah, here's a portfolio value portfolio. Let me share again. So here's how it's done. I started in January 2022, started with zero, $12.50 a month. It's now, what's that? $1,200 total. The return, 20.8% annualized. And so the point of this portfolio is there's two reasons I'm doing this. One, to show my students that you can build a successful portfolio with a small amount, right? But I also was curious if I could build a diversified portfolio that could beat the bigger ETFs that pay dividends. And I like to compare to SCHD. And so far it's beating that SCHD easily. And it's also beating the S&P 500. And again, you don't need a lot, right? I'm only doing $12.50 a week. Now, what I plan on doing is each year, because when people invest, as the years go by, they get more income usually from work. So they start to increase gradually the amount they're investing. So each year I will increase at $12.50 per week by the rate of inflation. So I have increased at one time by the rate of inflation, which, as we said, averages about 2.99% historically.
What is the average? Because I know this is a thing that they've been mentioning on CPI data. What is the average wage increase year over year?
Probably,
I shouldn't have.
Probably at least the rate of inflation.
Yeah, well, we'd hope, and we'd sure hope. Yeah.
But not every year is it like that,
yeah.
right? The last two years, inflation has been horrible. But yeah, it's got to be over inflation, I would think.
Yeah, because that would be cool. Because I know at my one of the jobs I had, one of the things that they used to do was so every year when you'd get your customary 2-3% raise that they would give you, you would increase they would automatically do it unless you took yourself out of this program. They would increase your 401k contribution by 1%. So if I would get a 3% raise and I was paying 6% my 401k, I would get my 3% raise and I'd be now paying 7%. So I'd still get more back on my check, but I would be getting less than, but like it's more money than I was used to anyway. And now I'm also contributing more towards retirement, which obviously depends on when you plan to retire, because I don't want to put all my money in a retirement account if I plan to retire before that. So I just thought that was pretty cool. So that's kind of a cool idea with your portfolio too.
Yeah. And my opinion, like I said earlier, if you get a raise, I think you should save 100% of it.
Yeah.
But that's just my opinion.
Yeah.
Here's a look at how the quarterly dividends, and this dotted line is the trend line that Excel can do. I thought that was pretty cool.
Yeah.
And then if you look at accumulated monthly dividends, this is how it goes. So this is something good that a new investor can look at, is that if you have a diversified portfolio of dividend payers, your dividends are going to increase consistently, right? Mm-hmm. And now remember, SCHD, that ETF that buys dividend paying stocks, that has like 300 stocks. I think over 300 stocks. So it's super diversified. And this portfolio has I think currently 69 stocks. So it is very diversified. And there's one thing. Now, most of these, 75% of the portfolio is what I call high quality dividend growers, like Microsoft, right? But I'm also working on a strategy that finds under the radar dividend payers, and they tend to be very small, not always, but they tend to be very small, but also very volatile. But check out their performance so far. Now, most of these have been held less than a year. And these under the radar stocks, they're returning 19.9%, but that's less than a year. The annualized performance is 41%, right? Well, how has that done versus SPY? SPY is just the more common ETF for VU, the S&P 500. It's up, it's 18.3% higher than SPY. How's it done versus stocks of the same size? Because remember, you really can't compare these under the radar dividend pairs because most of them are very small. So it's really not a good comparison versus the S&P 500, which is what SPY is. So how have they been performing versus stocks of a similar size? They've been trouncing them, 27.9% better. And how about versus the same sector, 22.8%. So far, and I've only been doing this since 2022, right? So it's not a big sample size. So far, these things are killing the market. And that sounds fantastic. Like, well, wow, this is awesome. Why not invest all your money in these under the radar dividend paying stocks? Because they're extremely volatile. Mm-hmm. The beta is huge. So when the market has a bad day, these things don't do well at all. But when the market does really well, these things just can skyrocket. And the current example, and this one is very small, it's not even a small cap, it's a micro cap. It's called Park City Group. Their total return in 10 months is 97.6%. They're a software as a service provider, and they had a yield of 1.2% because the stock has gone up so much that the yield is now down to 0.62%. So that's something that someone might want to look at too for a small part of their portfolio, is looking at some of these undiscovered dividend paying stocks.
Yeah. Yeah. I see a lot of people do that with, 5% or 1% of their portfolio value, where they'll put in speculative assets. Some people, do that with Bitcoin or whatever. And other people, this could be an opportunity to do that. Cause best case scenario, you put 1% of your, portfolio value in it and it blows up and turns into 10% of your portfolio. Worst case scenario, you lose 1% of your portfolio value. So it's got in the opposite of your shorting strategy, it has an unlimited upside and a capped downside because you can't go down lower than zero, which is nice unless you're shorting.
Yeah. And once your dividend paying stock pays you a dividend, as long as you're not blindly reinvesting that dividend into the same stock, which is what I don't do. I always invest in whatever's the best value at the time. You can't lose 100%, right? Yeah. I mean, if you get $1 dividend back, technically you can only lose the rest.
Yeah. Yeah, I know a lot of people that do that, because like one of the conversations I had on here that I thought was really, really a cool way to think about it was I think it was with Dave, and he was telling me that like his biggest regret in his dividend game so far has been selling. He goes, he's had a bunch of stocks that he's bought that were, you know, he's bought them and he shouldn't have bought them or whatever. But he goes, the ones that always stick are the ones that he sold, because he had an idea. He had a reason why he wanted to buy it. Now you can, that's kind of one of the strategies I'm thinking about switching to, like in 2024, would almost be like what I'm going to call like an active and a dormant portfolio. So like it's all going to be in the same portfolio, but pretend like one of these stocks, like right now, like Illinois Toolworks is like one I always think of. Like I bought Illinois Toolworks a long time ago. It's like 61 years of paying a dividend, paying and growing a dividend. I think their payout ratio is a little higher. Their dividend growth rate now is under 10%, which 10% is my goal. So like it meets, like it still outperforms the market. It's still paying and growing their dividend, but it doesn't have like the dividend growth rate that I like, and its payout ratio is creeping higher. So maybe I turn that into a dormant position where I no longer add to that position anymore. And I take any money that I was going to add into that and I get ready for a new position, or I identify a new position that does currently meet my things. Because like Illinois Toolworks, I think I'm up, I don't know what I'm up this year. I'm up a lot this year because I was down like 20% on that thing. And I think I'm up 14% this year. And it's not like, oh, it's 34%, Troy, like do your math. Like it's way more than that when you're down percentage. Like that's not how that works. Like you have to accumulate way more percentage just to get back to zero. I think it's something like 45 or 50% you have to gain back once you lose 20% or something like that. So yeah, I'm thinking about doing something like that where I have like active positions that are currently meeting all of my criteria. And then I have my dormant positions that I don't sell, but I keep them and I don't add any more to them. So
yeah, that's what this strategy that I've been using since 2022 for my students. That's what it employs. So it would, you know, originally buy, I can't remember what stocks I bought at the beginning, but the next week, some of those will fall out of the top 10 stocks, right? So I invest in whatever is the new stocks in, but I don't necessarily sell those old ones, right? That's why it's got 69 stocks in it so far.
Yeah. Yeah, that's a pretty cool. And like to me, everybody's going to be like, oh, well, then you start getting into too many stocks to manage or whatever. To me, like dormant positions really don't require any, like at that point, you just let it go. Like for me, another one that might be a dormant position is ExxonMobil. Like ExxonMobil doesn't fit my dividend growth rate, and it doesn't fit my payout ratio. I've just had it and I've held it and it's done really well for me, especially when it goes down. But maybe that's when I just hold until, because oil is very cyclical, like super cyclical. So like maybe I just wait until the next time when it goes down to $60 a share, like it's going to do. And then that's when I load up on it again. Maybe I stop buying ExxonMobil as my daily purchases. And that's only whenever it drops by a lot, then that's when I buy and load up on a little bit and then just let it do its thing, let it go all the way up, wait for it to go back down, add some more, keep doing that, rinse and repeat. So, actually,
yeah, go ahead.
No, go ahead. I was going to transition us.
I was just going to say that, yeah, there are some high quality dividend payers that you don't necessarily have to go and analyze, you know, every quarter. But some of the riskier ones in an industry that could be disrupted, I think a person does need to stay on top of that. So that's why for this strategy, I use those analysts that I trust to do the analysis for me. And when I say analysts I trust, that also means analysts that are independent, right? There's some analysts that are just bogus. I think Argus, if you go look, there's a company that gives stock recommendations called Argus. And if you look at them, it's like 85% of their stocks are buy.
That's optimistic.
Well, it's like they're afraid to say sell the stock. And why? Because then they get pushback from that company. So they're not independent. So you do want, if you're going to follow analysts, you want to follow independent analysts.
Yeah, that's a good take. Okay,
Yeah.
So I mean, speaking of selling and buying, do you have any biggest selling regrets or buying brags? I mean, that one that you showed was kind of a good buying brag, and then Home Depot was a good buying brag, but
yeah. How about a buying regret?
Oh, there we go. Yeah, I like that. That's good.
So, right, I'm more, as I get older, I get more conservative investing. When I was younger, I was, you know, my risk tolerance was really high. However, I mean, that's why I prefer investing in dividend paying companies, because they're almost always profitable, right? And a lot of people are new to investing say, well, you want to buy companies that are profitable, right? Well, I mean, if you really want to get in early, like on Amazon and stuff, you have to buy them way before they're profitable. Anyway, here's a buying regret, Voyager.
Yep.
What did Voyager do? It was a crypto exchange, right? And this is the only stock I've ever had that has basically gone to zero, because they got hacked, right? So they're basically out of business. So yeah, that's my buying regret. I don't really have any selling regrets. As far as biggest brags, Home Depot, as far as dividend payers goes, dividend growers, up over 1,700% and now yielding 29% on the original investment. I know some people hate yield on cost.
Yeah.
That shows you the power of dividend growth. Two other brags is I was interviewed by Forbes.com about my recommendation for Amazon and Nvidia. So I recommended buying them in 2016 and 2017. Amazon is up 287% and Nvidia is up 704%. On a split adjusted basis, that means Amazon back then was selling for $35 a share and Nvidia was $52 a share. Now you could Google the articles, just remember the stocks have split several times since then.
Wow, that's impressive.
Another regret
was the brag there the Amazon and Nvidia or being on Forbes?
No, it was Amazon and Nvidia.
Oh, okay.
Now I invested in Amazon at that time because that's when they turned profitable, right? It was about that time when they started consistently making a profit. Before that, they were reinvesting so much into the company that they were not profitable. Mm-hmm. But I do like a company that is reinvesting in itself.
Yeah.
Another regret I have, but doesn't have to do with selling or buying, is that once I got to the crossover point, which is where your dividend income can cover your expenses, I changed my allocation. In retrospect, I changed it to be too conservative. I wish I had stayed a little bit more aggressive, but better to be a little bit more cautious than too aggressive.
So that's a hindsight thing? Is that based on what you see the returns have been from being
exactly
aggressive? Okay.
Exactly. Everyone's how's that saying go? Everyone has 20/20 rear view vision or whatever goes. However it goes.
Yeah. We get it. Yeah. Oh, that's pretty cool. Yeah. I like to hear all these buying regrets or in your case, buying regrets, but then buying brags and selling regrets. So like, what lesson did you said with Voyager, your biggest buying regret, what was the lesson you took from that? Like, was there something that you could have looked at to see what was going to happen or?
Well, I was playing with investing in crypto, right? And even though I would always tell people, I'd say crypto is like investing in stocks, but with 17 extra layers of risk, right? Because even if you pick the perfect price to buy Bitcoin or Dogecoin or whatever you want, if you get hacked, if your security isn't good, you could get hacked and lose everything, right? That's not going to happen with your Schwab. No one's going to hack into your Schwab account. All of a sudden your Microsoft shares have disappeared, right? but that can happen with crypto. And so even though I was telling people that it's super, super risky, it wasn't a big amount. But I still, it's like, well, why am I buying these companies that are just speculative? However, you could say that like that under the radar stock dividend payer I have purchased, Park City, that's kind of speculative too, but that's only like 25% of the portfolio. So anyway,
kind of a lot.
What's that?
It's still kind of a lot.
Yeah. Yeah.
Especially with how like volatile that is. You could have a bad day in your portfolio and you're down 18%.
No, it's not going to be that much. Even last year, remember last year was bad. Those under the radars didn't do the best, but they didn't underperform by that much. but on an individual day, almost every day, you could look at your best performing stocks percentage wise. On good days, those under the radar ones are almost always the leaders, and on bad days, they're almost always the laggards.
Yeah.
Now, I know people don't want, not some people that are really conservative, they don't want to try these under the radar dividends paying stocks. So in 2023, I started another $12.50 portfolio that only does the other high quality stocks. And that performance, because this year has been good, has been really well. It's beating the S&P 500 too.
Yeah, that's pretty cool. Okay, so actually, this is going to be a really good question for you. So, what dividend milestones or achievements have you reached, and what role do those play in helping keeping you motivated? Helping keep you motivated.
Well, all right. So, remember, I was in the Air Force, the military, for 9 years as enlisted, and I was averaging $10,000 or $11,000 a year. Right? Not much. And then I became a teacher. Teachers don't get paid much. So my biggest milestone is that on a salary, now this is a family salary because my wife wasn't working all the time. On a family salary of $41,500, I eventually, now this was not overnight, I eventually reached an investment portfolio of $1 million. And most of that was dividend paying stocks, dividend growers. So that was my biggest achievement. And then like 3 years later, this is what new investors don't understand, is that the early years, your portfolio is just going to go up dollar amount wise because stocks average 10% a year, right? In the long run. Dollar wise, it's not going to go up very much, right? But if you keep at it in those later years, things are going to go way up. So after I reached the $1 million portfolio, after a long time, 3 years later, it had doubled, right? So you just need to keep at it. And even if you live in an expensive city like I do, you need to find ways to minimize your expenses. Don't be trying to keep up with the Joneses, the neighbors. For example, my car right now is a Honda Accord. Why a Honda Accord? Because their maintenance is very low. They're super reliable, but it was a 2002. So it's a very old car. Why do I need to buy a Mercedes or something really expensive? How
many miles you got on it?
120 maybe.
That's it?
I think so. I bought it years. I didn't buy it until my other car died, right? So I buy a car, I drive it till it dies, and then I go buy another used car.
Yeah, that's
because
smart.
cars are not a big deal to me. But since I am into the FIRE movement, I am not one of those people that think that you need to, don't spend anything. You need to suffer for years and years and years. I do spend on stuff that is important to me. Like my home theater is very expensive. My home theater is way more expensive than my car because my car is just something to get me from point A to point B. And so after I reached that portfolio, after I reached the crossover point where my dividends met my my living expenses, then I went to the fat FIRE level where it's like 50% higher than my expenses. So and what kept me motivated was just trying to get there. And what keeps me motivated now is this is what I like to do. So I want to start sharing it with people for free.
Yeah, that's pretty cool. Yeah, because I'm really hoping like that's, I don't know, what 22 years from now on YouTube's going to look like, if YouTube's going to exist or not. But like if I do get to retire early by 50, or if I get to retire earlier than 50 because YouTube does well for me or whatever, like that's going to be my job. Like I'm not going to be, just sitting around doing nothing all day. Like I want to do YouTube and I'll be able to actually do maybe 3 videos, 4 videos a week, or maybe do a stream in the morning where I talk to people and let them know, hey, here's what the market's saying. Like everybody's freaking out. Here's what I want. Like almost like a coach to be like, calm down. Like it's not going to blow up. You're not going to lose all your money if you have the money to put in or whatever you got to say. But like that would be really cool. And then I say this all the time on my channel, and this is what you were getting at, is when you first start, like in dividend investing and investing in general, but specifically dividend investing, it does take a very long time. Like you're not going to go from making $1 this year in dividends to $1,000 next year in dividends, more than likely. So what I always suggest to people is, one, track your progress. That's very important. And when you track your progress, I focus on the percentage increase year over year. And if you guys watch my monthly recaps, you'll see that. Focus on the percentage increases year over year. And until those get small, when your percentages start to get small, 10%, 20% year over year increase, which is, still pretty big, especially when you're at $1 million portfolio, that's really good. But when your percentages start to get small, then you can focus on the dollar amount received in dividends. And then that number will be big enough to motivate you, because it is such a long thing. So like I did that when I was first starting, and I was making $2.69 for May. Like that's not you're not doing anything with that. What do? Go to McDonald's and get a burger with that? Like that's all you can do. But like then the next year it went to like $5 and something. That's a big percent year over year increase. And then the next year it went to $30 and something. Like that's a huge percent increase. And then like still $30. Nobody's writing home about that. But then eventually I'm going to get to the point where I go from $900 a month to let's just say $1,300 a month. And like, okay, yeah, that's, not as big of a percent increase, but now I'm making $1,300 a month in dividends. Like that's pretty cool. Like now that's the motivation and inspiration right there. So, I do like that you said that, because it's a long game. But if you play it right and figure out ways to, stay motivated and stay on track throughout the whole thing, it's going to be worth it. Like I don't know many people that have done dividends, quote unquote, the right way that haven't worked.
Yeah. I heard another person, this is not my idea, but they said, think of it as your goal is to pay a certain bill. So let's say you have like a Netflix bill or whatever, I don't know what Netflix costs nowadays. But maybe you got like a $13 a month bill. Well, your goal should be, let me build these dividends until the monthly dividend can cover that, right? Mm-hmm. And then you can think of it, I got Netflix free for life.
Yep.
And then keep growing it to include another bill, or just like a bigger bill, like your cable bill or whatever.
Yep. That's what I do. I have a sheet on my spreadsheet that has all my bills in it. And like each month I go through there and I'm like, oh, okay, well, mortgage is this much, my car insurance is this much, my cell phone bill is this much. This month I made $70. My cell phone bill is $68. I technically didn't pay for my cell phone this month. And like, it's going to vary, different months. Like my 1, 4, 7, 10 months are very low for me. Like I have one dividend payer in that month, or those months. So like those are my smaller months. But then I have like this group of months, the 2, 4, 2, 5, whatever, 8, 11, those months, that's my biggest month. I'm going to make over $100 this month in dividends, which obviously isn't enough to pay my mortgage, but like that's way more than I need to pay my cell phone bill. So to your point, I'm paying my cell phone bill, a week of gas, and my cable, or my my Spotify. Like I'm paying all those bills this month just off of that. So, and obviously we're talking figuratively paying those things, because you want to obviously reinvest that money back into your portfolio. But it's the idea behind it of like, oh, okay, like that you can get behind that when you start checking off bills. And then what Rex has gotten to is got to the point where he can check off all his bills with his dividend income, and then he's good. So,
and then you say, if you still have time in life to accumulate it, then you say, well, let me see if I can get $2,000 a month extra for travel or something like that.
Mm-hmm. Yeah.
That way you get to the fat fire level.
Yeah, so the fat fire is a really good segue into my next question, and I ask everybody this because I'm gonna need help. How or when do you know when enough is enough? So when you reach fat fire, which you'll reach, what do you do then? What's next?
You retire.
Well, you're gonna retire before you hit fat fire, more than likely, right?
No, I've already reached fat fire.
So, but when you reach fat fire,
my dividend income is, I think, 50% more than my annual expenses.
Isn't that fat fire?
Yeah, that's where I'm at. So I've reached it already.
Oh, okay. So, but like in
other words, if I needed $100,000 to live off of, I now have $150,000 of dividend income.
Yeah,
to me, that's fat fire.
So, like, would you since you enjoy investing in stocks and finance and stuff so much, like, you're not going to just say, okay, I win at life, I'm done at 150. Like, what do you do? Are you going for like 160? Like, what's the next goal?
Remember, I'll be watching the Seahawks game because I live in Seattle. I'll be watching the Seahawks game. And I think, oh, I wonder if I should try this strategy or tweak. Maybe I should look at this to see if this, in other words, I keep coming back to this stuff, right? So I love this stuff. This is what I do for fun. Like, for example, this summer, I'm teaching 2 online classes. I don't need to record the lectures. So the lectures have already been recorded. So basically, what do I do all day? I go to the gym, and then I come back, I look at my investments, and I try some new tracking stuff and some new research. This is what I do forever. Now, because I'm approaching retirement, I've been studying people on what they say you should do before retirement and what's a successful retirement. And basically, besides social, you need to have social connections. You need to have a purpose in retirement. Because if you think, oh, I'm just going to retire because you hate your job so much, if you hate your job so much, this is an easy trap to fall into. You say, oh my God, I just want to not work at all. Well, that's nice, but you need to be able to replace it with something. So anyone going into retirement, or like you're asking, how do you know when enough is enough? You need to have a plan on what your next stage of life is going to be. And I love learning, so I'm going to continue to learn other stuff, right? So yeah, just enjoy life in whatever manner that is for you. But you still need to have a purpose in life.
Yeah, I like that. Like that's my thing too, is like if I get to the point where I have enough to retire off of dividends and possibly go for that fat fire too, is I don't want to not do anything. So if YouTube's still a thing, I can still do YouTube. And then maybe like, since I don't care about what I would make at a job, I can literally seek out jobs that would make me feel best. So if I wanted to be a personal trainer and just help people, I know I don't make a lot and I don't have to worry about the number of clients. And if I want to work for 3 hours in the middle of the day and just do 3 clients with whoever I want to help at the time, whether it's a young kid or an older person or whoever it might be, I can do that. Cause like, the money doesn't matter. It's just, I'm doing what I want to do and I'm getting fulfillment out of myself. So
yeah. Or you can volunteer.
Yeah. Yeah. Soup kitchens. Yeah. Especially around the holidays, like all kinds of stuff like that. So that'd be really cool. And a lot of times people, rightfully so sometimes, and then also not rightfully so. A lot of people say they don't have the time to do stuff like that, or they have to use their time that they do have to make money. When I get to that position, I have more than enough money, so I can use my time to help people that might not have the time or the money to do it. So that's kind of one of the things I want to do too. So, okay. So I think I saw a slide on this, but we didn't talk about it. So do you have any, like, what is your specific criteria that you use to select your dividend stocks?
Some people might think this is overkill.
Uh-oh, here we go.
But yeah, I do have a lot of criteria. Now, all this stuff I can get from the internet. I can download this into my giant spreadsheet. So I look at 4 areas. The dividend's past performance, right? So I want something that's growing their dividend. I can show you in detail. I just want to give you an overview. So dividend's past performance. But because I want something that's going to be able to a company that's going to be able to raise its dividend, I look at the future outlook for the dividend, right? And because I'm living off these dividends, I want something high quality. And then, of course, value. So let me share my screen here. And we'll look at dividends performance. This is the past performance. Share a window. Share, maximize. All right. So obviously I look at the dividend yield. That's included in this. I am looking at the dividend growth in the last 12 months, also the last 3 years, the last 5 years, and the last 7 years. And then I look at the number of dividend increases in the last 7 years. Now I rank these using the Excel rank function. And so each one gets a percentage. Like a company with, now, everything else being equal, you do want a higher yield, right? So whatever has a higher yield is going to be ranked higher in that. But you also want growth. So really what this is looking for is dividend growers with a decent yield, but some of them are pretty small. I mean, you saw that when I bought Home Depot, it was a 0.8% dividend yield. And it does come up with some that are higher dividend yields, 3, 4, sometimes even 5%. So that's 25% of my criteria This is the dividend's past performance. But I want something that's going to be able to raise its dividend in the future. So here's the dividend's future outlook. I look at the payout ratio over the last 12 months, but I also look at the forward payout ratio. That's just looking at, well, how much do analysts think the company is going to earn over the next 12 months? And check out, then you compare the current dividend with those future earnings. Obviously, if something's going to be falling in earnings over the next 12 months, that's probably not going to be able to raise the dividend, right? And I also look at payout ratio compared to the company's average payout ratio over the 7 years. Now, like you were saying earlier, payout ratios can vary by the different sectors and different industries.
Mm-hmm.
So, I mean, if you're into companies like the tobacco companies, they have a really high payout ratio.
Yep.
But that doesn't necessarily mean that's a bad thing. So let's say Altria has, and I'm just making these numbers up. Let's say that their average payout ratio in the last 7 years was 80%. And let's say now it's at 65%. Well, that looks like maybe they have a chance to increase their dividend in the future, assuming they're going to maintain that average payout ratio. And I'm not saying cigarette companies are good buy right now. And I also look at, and this is even more important, because payout ratio it's comparing the dividend and dividing by the earnings, right? And I said that earnings are much easier to manipulate by accountants than a cash flow. So even more important, I look at dividend as a percentage of cash flow, but you only want to look at cash flow from operations, because that means the cash flow from running the business, as opposed to cash flow from selling your factories or cash flow from selling bonds, which is debt, right? Mm-hmm. And then I also look at the estimated earnings growth over the next 12 months, because remember, I want to buy a stock that's going to be able to increase its dividend next year. And if their earnings next year are likely going to be negative, chances are they will not be able to raise their dividends. And then the last one is the buyback yield. And buyback yield is just looking at, well, how many shares outstanding did they have last year versus this year? And what you want to try to avoid, everything else being equal, is a company that is issuing more and more and more shares, because as they do that, you're owning a smaller and smaller percentage of the company.
Yep.
So basically, buyback yield is looking to see if they are buying back their own stock. And if they are, that could be several good things can benefit from that. One of them is, if the company's doing it right, they're only going to buy back the stock when it is undervalued. And so a company that's buying back its stock can be an indication that the company is undervalued. Now, I say can be because there's some stupid management out there that that time this incorrectly, right? Mm-hmm. They don't buy it when it's low, they buy it back when it's high, so they have to pay more. Also, by having a company that's lowering its common shares outstanding, if they maintain the same dollar amount that they're paying for their dividends, then they can increase the dividend. And also, if a company is buying back its shares, that's increasing demand for the stock. And when you increase the demand for a stock, that's going to tend to increase the stock price, right? And you get all these benefits of buying back yield without any taxable consequences, right? Like, I mean, if a company pays a dividend, that's nice, but that does have a tax consequence if it's in a taxable account. Mm-hmm. So there's lots of good things about buyback yield. And let's look at quality. So my quality is divided by, or is spread up, or divided by risk. And you preferably that you want obviously a lower risk company. You want competitive advantages, which another way of saying moat, which you talked about earlier. But you also want to look at the trend of the competitive advantages. If they are starting to fall, even if their competitive advantages are really strong, there's a good chance I will not buy that company, or I won't invest any more into it. And then you want to look at the financial health of the company, and that includes debt, stuff like that. And you want to look at the management. And this is the hardest one to quantify, I should say. And you want to look at earnings quality, which you can easily do. Well, not so easily, but you can do with accounting formulas that I use. And you want to look for accounting red flags. Have you heard of Enron?
Yep.
Yeah, Enron, its stock price was going way up. It's just going crazy. Well, the way they were able to do that is they were doing fraudulent accounting. So they would take something that was an expense, and they would not categorize it as expense. So they would basically taking something as an expense and removing it as an expense, right? Which makes their profit look better. And then they would categorize it as an asset, so which would make the balance sheet look better. So
not only were they supposedly not spending money, but they were adding things to make them more valuable.
Yeah, it's just it's just horrible, and that was a perfect case of why you should not invest a large part of your portfolio into your company stock. So those because Enron was going up so much, people who worked there was like, oh yeah, this is great. I'm going to put all my I'm going to maximize my the employee stock purchase program, and so a lot of them had 100% of their retirement into the Enron stock.
I feel like there needs to be like lawsuits on behalf of the employees on that side. I mean, I obviously, when you invest, you take risk or whatever, but like when it's insider, like fraudulent trading, like I feel like that should be illegal. I mean, I think it is, but like, I feel like they should get compensated for that.
Well, you can buy your own company stock through a stock purchase plan, as long as you don't know stuff that the average consumer doesn't know.
Insider trading.
Yeah, insider trading. And then the last category is value. And again, I look at risk, and looking at value investing, you want a margin of safety, so that if you think the stock should be worth $100, you don't necessarily want to buy it at $99.50, because that's not giving you much of a margin of safety. And then so I rank all these, and then I come up with a percentage score, and then I buy the ones with the best score.
Well, that's simple enough.
And I can do it all automated. It takes like a half an hour to download the data. If I knew programming, I could probably figure out how to automate it, but I'm not the best programmer in the world.
Hey, there you go. When you do your fat fire, that's what you can learn, and then you can just.
And that's what I'm doing. I'm learning more about Excel and stuff like that. I love that. I love learning. As a teacher, you should, right?
Yeah, that's good. Yeah, I mean, you can't expect people to learn from you if you don't like learning yourself. So.
Yep.
Okay, so I mean, we touched on this one before, but how important is staying diversified, and what are the rules that you follow personally to help you achieve that?
So, like I said, since I'm going to be planning on living on my dividends, I want something that's very diversified. I'm not comfortable with my recommended newsletters portfolio of only 17 stocks. Like I said, for a lot of people, that's plenty of diversification, but not for me, not for my mental health, right? And so what I'm doing with this portfolio that I started in 2022, and then the other one I started in 2023 that buys these dividend paying stocks, is I'm limiting the portfolio position to 4%. So if something gets over 4%, even if it's on my top 10 list, I won't buy any more of it.
Okay.
And again, that's a very conservative thing. I think for most people, that's probably too low. But hey, I'm an accountant. I'm an accounting professor, so we do things conservatively.
Yeah. Well, I mean, at the end of the day, like I've read the 5% in one stock, 20% in one sector, kind of diversification standards that like is, kind of widely observed. The issue for me is I have 11 stocks. And I was at the point where, like, when I first started, which is kind of backwards, when I first started, I had 39 holdings, 36 individual stocks, and 3 ETFs. But the issue was I was not contributing a lot of money, and I didn't have a lot of money in the account. So I didn't have enough money to spread 39 different ways. So it was just like, okay, I have $27 in this stock and $43 in that stock. Like, I didn't have anything. So like for me, I reduced that down to, what I ended up whittling it to now. And now I'm able to build a position And I actually talked to my dad about this, I don't know, months or a year ago, where he was saying, oh, I want to try to get a certain number of shares. And that's how he was going to do his diversification. And I told him, I was like, well, I don't think that's a wise, because if you have one company that costs $20 per share and the other company that costs $500 per share, you can't really go for 10 shares of each company before you add something else. I'm like, you have far more value in this one company than you do the other just by stock price. So I was like,
Yep.
you would really want to do it by like current value. And that's how I sort my diversification. It's just like, it's based on the percentage of each. So all of mine, when you watch like a monthly recap and stuff, you'll look at the ones that I want at 88% of my portfolio. They're all valued the same, whether it's, Starbucks that cost whatever Starbucks cost $100 per share, or whether it's Visa that costs $200 and something per share. They're all valued the same. So I have vastly different amounts of shares per company, but my value is the same.
Yeah. Yeah. I think it's silly when people say, oh, you need a certain number of shares. And I think this stems from like back in the 70s when you were buying a stock, I think you had to buy lots of 100. So you had to buy 100 shares, right? So only people with a lot of money could invest. And it wasn't until recently that we have these fractional shares.
Mm-hmm.
So that's what I do. When I invest in the stock, I say I'm going to invest 3,000 or 4,000, whatever, into the stock. And I just put that amount in the stock. I don't care how many shares it is. And I find it funny that some people are so anal retentive that they can't handle a fractional share in their company. But I use Fidelity and they have fractional shares. So
yeah.
And obviously with this $12.50 portfolio,
you're not buying many full shares.
No, I don't have a full share of anything. Right? It's on average about $1.25 in each stock. But you could build, like I showed you, that portfolio is now what is it?
Hey, in 4 years, that'll be enough to get you like 3 shares of AT&T.
Yeah, it's already up to It's already up to $1,200. So yeah, you don't need to buy these large amounts of shares.
Yeah. Like imagine wanting to not really diversify, not believing in fractional shares, and wanting to buy Berkshire Hathaway. What do you do then?
Yeah, exactly.
Good luck saving $500,000.
Yeah, I only have 99 shares of Berkshire Hathaway. I can't afford that.
Yeah. I don't want to get those fractionals are good. Then they're like, oh, well, what does that do to your dividend? I'm like, okay, well, you have 12 and a half shares. So take 12 and a half times the amount it pays per share per year. Like that's your answer.
But wait, I'm not good at math. Well, then if you can't do simple addition, multiplication, division, you shouldn't be investing on your own.
Yeah, you might want to invest in yourself or something, or do an ETF or something.
Invest in Rex's accounting classes.
Yeah.
I literally teach a desktop calculator class. They can teach that.
There you go.
Or they can.
Yeah, that'll be useful. Okay, so do you have? I know some people don't care as long as it makes money, which I know that's how you were in the beginning. Do you have any favorite stocks or sectors?
Well, here's what how about I show you what I'm going to buy tomorrow in the $12.50 portfolio. No, so I'm doing these $12.50 portfolio, but I'm also buying these in much larger amounts in my own portfolio. So this is just not just for my model portfolio. So let me show you my screen. So here's what I'm buying tomorrow. Share a window. This one, share, maximize. So they're listed from top to bottom. So my system is currently saying Schwab is number 1. And notice Microsoft is in there too. So it's not looking at just high yielding stocks, obviously. You got American Express, FMC, travelers, companies. And then you got the sectors over here. And then you got the sub-industry. So it's just tomorrow's purchases themselves are pretty diversified.
You got a lot of financials in that. There's 4 of them out of those 10 stocks.
Yeah. For this week, that happens to be a lot. But if you look at them, they're all different industries.
So do you let the numbers speak for themselves, or do you have things that you restrict to that portfolio? Because I'm assuming it's in a taxable account. So how do you feel about REITs in that account?
How do I feel about what?
REITs.
Oh, I will invest. Yeah, this is a taxable account, I will invest in REITs, but this system can't find a lot of REITs with a large moat, large competitive advantages. So it's not highly, it doesn't have a lot of REITs in it.
Yeah.
I actually would like it to have a little bit more. But I recommend that people hold REITs if possible in a tax deferred account.
Yeah. Because I have a VNQ as my REIT holding, and that's in my Roth IRA. Because I didn't feel like picking, individuals, because I know a lot of people like Realty Income. One that for whatever reason, it keeps changing how it's classified. And I actually covered it on my Power 5 that was released on Friday. It was Arbor Realty Trust. It's technically a financials, but I mean, it's got realty in the name. But like that is it's one of the weirdest stocks I ever see. It has over a 10% yield. The dividend growth rates are both the 3 and 5 year close to 20%, and it's outperformed the market. Like that's not something you find with a 10% yielding company. Like that's something you find with like a 0.5% yielding company. Like not. So like that's always really crazy to me. And everybody's like, oh, I want to buy this stock or this stock. And I'm like, what about like if you're not against this one, like look into ABR. Like that one's.
So what's the ticker symbol? I'm looking it up because you got me curious.
ABR.
ADR.
AB as in boy.
ABR.
Yep.
ABR.
Yep. Arbor Realty Trust.
I've heard of them. I just don't know a whole lot about them.
Yeah, it was just on my Power 5. Like every time I go through the X dividend, because once a quarter, all the same stocks roughly have an opportunity to take the crown for that week. And I think every time that I've done the Power 5 with the dividend yield, Arbor Realty Trust takes it. And I know a lot of people are watching that and they're thinking, oh, I want more higher yielders, and Troy never talks about the higher yielders or whatever. And I'm just like, hey, look. When I add the filter of a dividend streak of 5 or more years, and most importantly, outperforming the S&P 500, fact is most of the high yields fall off the list. I don't know what to tell you. Like most of the time when you have an 8% yield, you're sacrificing today's cash for tomorrow's cash. Like that's how that works.
Yeah, it says it's a mortgage REIT. You invest in a diversified portfolio of structured finance assets in the multifamily, single family, and commercial real estate. So it does have commercial real estate, which is a little bit riskier than some of the other stuff, but at least it doesn't own malls. Well, I guess it could own malls. Yeah, you might want to look at it to see if it owns a lot of malls.
It doesn't Realty Income. Isn't that one of the bigger malls, or is that I don't remember which one it is. I know one of them. It's either like Realty
Simon Property Group.
That's what it is. Yep, I remember that. Yep. I was gonna say because I know there's a couple of REITs that are always talked about in the groups, like Main Street Capital, Glad. Obviously Realty Income. And like I said, I didn't want to worry about picking them, and I wanted the tax advantage. Obviously it's an ETF, so I think it's tax advantage anyway, but so I just do VNQ in the Roth IRA and just going about my day. I'm like, I got my REIT exposure in there, and I'm pretty sure, the S&P 500 and those have some REITs in there as well. So.
Oh yeah. I think it's about 2%.
Yeah. So, I mean, it's nothing crazy, but I mean, at the end of the day, I do invest in real estate because I own my house. So like, I'm not, not into real estate at all. So I have my exposure there. So.
Yeah. One thing I noticed on our Facebook group is a lot of people are buying these business development companies.
Oh, BDCs. Yep.
A BDC. Yeah. Which is not, I'm not against them, but people need to realize what they are. Those can be higher risk. Some of those can be very risky. So just people need to understand what they are invested in.
So I don't know if you saw, it's my most popular video on my channel. I did a video on Yield Max funds. Have you seen that?
Not yet.
So the Yield Max fund video, I'm getting pretty good responses on it. Like I said, it's my most popular video. And it's a covered call ETFs, and they have literally, I think the TSLY, which is a covered call strategy on Tesla, has like a 77% yield.
Yeah.
And the video idea, my premise was, I know nothing about these things. I wonder if the covered call that it's doing is outperforming because it's getting all these dividends, 77% yield. I'm like, Tesla doesn't even pay a dividend. Is it better to hold TSLY instead of Tesla itself? So I did research on every fund that YieldMax offered in that time frame, and every single one of them, spoiler alert, every single one of them underperformed the asset it was covering. And
Yeah.
I get a lot of responses back in the comments, which I appreciate the comments anyway, but I get a lot of responses. One, that the time frame I used was too small. I used the maximum time frame from each of those funds. It's only like the longest one's like a year old. So I used the longest time frame I could. And then two, they're like, well, in a bull market, the covered call strategy doesn't really work well, but in the bear market, it will work well. And I'm like, okay, but like TSLY, which is the covered call on Tesla, is 77% yield. The total return of that with the 77% yield is underperforming Tesla that doesn't pay a dividend in general.
Yeah. So these are covered call strategies, right?
Yep. They have Amazon, they have Apple, they have Tesla, they have Nvidia, they have ARK, which is already a red flag to me because ARK's trash. But and then they came out with a bunch of other ones too recently since I've done the video. But like that's their thing, and I was really curious about it, so I wasn't doing the video to bash anybody that owns those or whatever. I was doing the video because I was like, okay, I know nothing about these. Let me do my kind of research on these and let you know what I think. And then also, I see a lot of people telling me, hey, this is really good for yield or whatever. And this is where it comes down to understanding your timeline, because something like this might be way better for you than it is for me, because you need the money closer to now where I don't. You could literally transfer your whole portfolio into those and literally tenfold whatever your income is right now. You could do that tomorrow. Like, that's how crazy those are. Because those are, like, I think the lowest yield's 38%. Like, you don't have anything in your portfolio getting close to 38% yield, but it's also way more risky. So like, that's the thing. And I like the other thing that I wanted to bring up to people on those funds is the thing I'm concerned about is the audience those funds are going to attract. It's not people that are educated and deep into their journey like you are, and many other people that are close to retirement, because you guys have been there and done that. You know what you're doing. What those funds are attracting are people closer to my age that see a 77% yielding fund on a cover call strategy on a company that they know and love, which is Tesla, one of the most popular companies out there. And then they're like, I can get 77% yield, but like, they don't need the money today. Like, that's what I'm trying to understand, get these people to understand, is like, you're sacrificing, because a lot of times what will happen with these funds is they lose money as capital appreciation, but then replace it with the dividend. And what I always say on the channel is that's like these companies giving you $75 in your left hand and taking $100 from your right hand. That's what they do. Because in the long run, you're losing money. And like, obviously Tesla is a different example because they don't pay a dividend. So you have to sell your shares of Tesla to receive the income. But like, they have a one on Apple, and Apple doesn't have a big yield, but Apple's small yield and total return is outperforming their covered call strategy on that same company.
Yeah. So these covered call strategies, by definition, what they're doing is they're giving you current income now, right? But what are they taking away? Because there's no free lunch in investing, right? So they're taking away the chance for a huge upside. And that's just way covered calls work. So, but you also are exposed to a large downside. So they're taking away the possibility of a home run to give you some singles, meaning singles being current income, a higher current income than what you could get by just owning the thing itself. So by definition, over a full market cycle, covered calls will underperform the underlying asset because they're taking away the bull markets, the big bull markets. Now, if something was steady and never had any large increases, you might do okay. But you just have to realize what you're giving up when you're doing these covered call strategies. You're giving up the possibility for the home run. And in a full market cycle, there's probably going to be some home runs that you're going to miss out on. In the short run, you might come out better. And if you're just in it for the income and you want to be able to live off that income and you never want to have to sell shares, that might be a decent strategy for someone else. But like you're saying, performance-wise, you would do better just owning that underlying asset. But in some cases, like Tesla, you're not going to get any income. So I don't really like covered call strategies. I don't do them myself. But for some people, they might be right if you just can't handle the volatility of the stock market and you never want to look and you're worried about sequence of risks and you don't want to have to retire and then all of a sudden the stock market crashes, right? And then, because that's the worst thing that can happen when you retire, if you're someone who's going to be selling off their assets to live off of, because if the market tanks right when you retire, you're going to have to sell a larger amount of your portfolio to be able to survive that year. Mm-hmm. So that's the dangerous sequence of risks. But yeah, like you say, I'm not a fan of the covered call strategies. At first, I thought they were a really good idea, and I tried using them, but they're not my favorite.
Yeah.
Well, just to just a quick digression here. I know people watching this are going to want to know the high yielders. So here's my top high yielders, averaging anywhere from 3.7 to 5%. But yeah, I'm not a big fan of covered call strategies.
I've talked about a few of these on the channel. NiSource is one I've talked about. They've actually outperformed the market, being a higher yielder, which I don't know. The high yield's so relative. Like, some people see NiSource with a 3.7% yield. They're like, what am I supposed to do with that? Like, if I'm following the 4% rule, I don't even, whatever. I don't know. But to me, I have ExxonMobil, and I think my yield on cost on ExxonMobil is like, 3.9% or something. And that's by far, my portfolio average with ExxonMobil is like 2%. Yield on cost. So like ExxonMobil is literally ExxonMobil and AbbVie are the two that like carry my portfolio in yield on cost. Because everything else is like Visa and Apple and Microsoft, they don't pay nothing. So, but like I said, the cool thing with that is when you do dividend growth companies is not only do you get the capital appreciation from these companies just being juggernauts in their own industries, but you also get the dividends while you wait, and the dividends are growing at exponentially greater paces. So
yeah. I guarantee you, this Hasbro company, the toy company, they're not going to be increasing their dividend by a large amounts in the future.
Yeah. I'm
not saying don't buy it. I'm just saying that, if you're looking for if you're expecting a large increase in future dividends from that company, you're probably not going to get it. It's not really in a growing industry like tech or anything like that.
Yeah. I mean, I think me and you, when we were talking months ago, I told you about those get paid weekly portfolios that I made. And the one was the higher yield and one was the higher growth. And I mean, I outlined that in there, and I thought it was pretty cool to see the statistics behind it. Like, hey, this one has a way lower yield, but it's quadrupled the market in the last 10 years. And like the dividend growth rate on average was like 13%. And then you have the flip side of like, oh, I want to get paid weekly for my dividend portfolio. Here's a dividend yield of 5% on average, but it's barely outperform. It's basically keeping pace with the market, but you're getting a 5% yield, which is a win because the S&P 500 is giving you like 1.6% yield. So if you can get a 5% yield and perform the same as the market, I think that was a pretty good compromise that I did there.
Oh yeah. There's nothing wrong with high yielders. It all depends on what your goal is, right?
Yep. Yeah, I agree. Okay, so I think this is the second to last question I have. So are there any dividend myths or misconceptions that you would like to debunk? Like, this is your platform to do so.
Well, I think we mentioned this earlier. If you plan on living on your dividends, and that's the ultimate goal, right? They need to increase at least by the rate of inflation. So you don't want just high yielders who are not going to be able to increase their dividends at all, or just less than inflation, because that's not sustainable if you're living off that. So, be careful about just investing in all these high yielders. There are some high yielders that I do like enterprise products, the MLP, Master Limited Partnership. That pays a much higher rate, I think probably 7%. But, that's normal for it. And it's not going to grow a lot, but it's going to pay you a lot of dividends.
So can you speak on something here real quick? Sorry to cut you off. So when you say that you want your portfolio, the dividend increase to increase by at least the rate of inflation, can you break down the difference? Because I know a lot of people that do this where they see that their portfolio value is going up by the higher pace of inflation, but their dividend. So like basically my dividends are increasing by 5% year over year, but I'm still contributing $10,000 a year. And like understanding that when you stop contributing, then it relies on just the assets in the account, and you're not getting what you think you are because you're really propping up your numbers by you adding money to your account.
Yeah. Obviously, if you're in the accumulation phase where you're investing more and more each year, of course your dividends are going to increase unless you're doing something horribly wrong. So you have to look at the individual company level to see if that company is increasing its dividend. If it's some big telephone company and it's not increasing its dividend, but you just happen to be buying more and more shares, well, of course your dividends overall are going to rise. So you have to look at the company level, not just the portfolio.
Yeah, I mean, AT&T is an example of that. I've seen a lot of people, buy the company and then like they compound the mistake almost where they do the drip back into it. So it's buying more share. And I always call that like trying to save a sinking ship with a cup. Like that's what you're literally scooping. You're just like, okay, if I keep scooping this fast enough, we'll stop taking on water. I'm like, no, you're taking on more water than you can take out with that cup. Like it's like you're delaying the inevitable at a certain point. Like it's going down, you're losing money. They're cutting the dividends. No matter how much money you add to that and how much money you reinvest from their dividend, it's still losing value.
Yeah. That's exactly why, the same reason why I avoided Intel. Morningstar loved Intel, kept recommending Intel, and I'm thinking they're not going to be able to grow their dividend. Management is horrible. Management became a lot worse. They used to have good management, and now look at the dividend growth. It's not good at all, and they're lagging behind NVIDIA, AMD, all those other companies. So yeah, you have to be careful. Just make sure that these companies are going to be able to increase that dividend, or at least grow their earnings, right, in the future. So avoid those industries that are kind of in a dead end. Another thing I would say about misconception is that, and I think we touched on this, is that some investors think you can't build a large income stream from dividends on a small salary like mine. Obviously you can, and that $12.50 portfolio I'm going to be sharing shows that, it's BS. And most people, not just investors, most people are impatient. Check to see how many people Google get rich quickly versus get rich slowly, right? Everyone wants everything now because they're impatient. So if you're investing in just any type of stock, your portfolio is going to grow slowly, but as you get older and your portfolio gets larger, then that 10% average gain per year is going to, dollar-wise, going to be much greater. And the same way with if you're investing for dividend income, at first it's just going to be a trickle, right? And you're going to say, why am I doing this? I got 36 cents of dividends in my first month. Well, if you're impatient, you're not going to be able to grow your wealth. You have to have patience. And so, who was it? It was Einstein said, eighth wonder of the world is compound interest. Mm-hmm. He says, he who understands it earns it. He who doesn't pays for it. And the best example I could give of that is people who don't pay off the credit card every month.
Yep.
So stocks historically average 10% a year, right? So what do credit cards charge?
Like 24%.
If I could get 24% a year, if I could get just half that, 12% a year, the difference between 12% a year versus 10%, which is what stocks average historically, it's huge.
Yep.
So anyone who is paying 24% of interest really needs to do all they can to pay that off, because that's you can't get any type of investment that's going to pay you that much, unless maybe you own Visa or MasterCard and are charging customers that. For newbie investors, compound interest, for those that are really new to this, compound interest just means when a person earns on principal balance and is reinvested and generates additional interest. Mm-hmm. So your compound interest means you're earning interest on top of interest.
Yep. Think of it like the dividend snowball.
Yep. And just the opposite is true too. If you have a credit card balance and you're not paying it off, that balance is just going to keep growing. If you're making the minimum payment, you'll never pay it off.
Yep.
A lot of times, right?
Yeah. Yeah.
So that would be my number one personal finance tip is get rid of any high interest rate debt. Yeah.
So what does the threshold for what you consider high interest rate debt, does that change based on the environment, or do you have like a certain number that you consider high interest rate?
If just as simple as it can be, anything. Okay. So what do people invest in their retirement the most? Stocks. Why? Because they have the highest return historically. What's that return? 10%. for me, anything that's higher than 10%, you can't afford to pay that because you can't earn that much interest, right? Or any type of return. So anything over 10% is definitely high interest rate that you need to avoid if at all possible. Like you've got a mortgage. What'd you say your mortgage is?
2.75.
That's not high.
No, I'm not paying that either. And my car's paid off. So
inflation, right?
Yeah.
That amount is going to be kind of decreasing the real value of it in the future. So yeah, don't pay that off unless you can get something lower in the future, which probably won't happen.
Yeah. I mean, I was looking at like the historical interest rates for like mortgages and stuff. It's like 4 or 5%, like average.
Yeah.
So like,
you know what they used to be? What the high was?
I don't want to like,
it was like 17%.
Okay, so I remember my stepdad was telling me this, that back in the day, you used to be able to live off of the interest that would come from your savings account. Like you'd get like 17, 18, 19% interest on a savings account, which now my savings account interest rate was disrespectful. Like I said that in my last video.
Okay. When mortgages were that high and banks were paying that much in savings, why were they so high? Because inflation was super high, right?
Is that when Paul Volcker was the Fed?
Yeah, that was back in the 70s when you had runaway inflation. So even though it looked like, well, yeah, back then I could live off of my savings account yield. No, it was probably paying less than inflation. So your amount your real value was falling.
Huh.
So really you have to look at real returns, and all a real return is the return of your investment minus inflation, right?
Yeah.
So that's why, something like a savings account or interest on your checking account, you can't, you're not going to grow your wealth because it's way lower than the rate of inflation.
Yeah.
Just to stay even, purchasing power wise, your returns on your investment have to match inflation. If it's lower, then you're losing purchasing power.
Yeah. My interest rate, I had a money market account with my bank. I was getting 0.1% interest on my money market. And I was like, that's disrespectful. So I moved it to SPAXX, which is the cash holding in Fidelity. I think right now the average 7-day yield's 4.91%. So I put my emergency fund in there. I know I don't touch it. And then anything over my emergency fund, I invest every month.
Yeah. I had a business checking account with Bank of America, and they would brag that they paid 0.1%. They said, "Oh, why don't you open up a savings account? We're paying 0.2%. Let's grow your wealth." And I would talk to the banker when I was there. I'd say, and they would try to get me to do that. I say, "Really, 0.2%? You don't think I can do better elsewhere?" So I call them Skank of America.
Yeah. They're not. Yeah. It's well, and see, that's the thing is like companies like that will prey on the financially ignorant, which sadly enough, most people are financially ignorant. Just because like everybody sees it as intimidating. And while there's a lot to learn, it's not intimidating.
Right.
Like, cause you can always, like, that's what I was saying. Like you always find your starting point. Starting points by reducing your expenses and increasing your income. And then you can start from there and say, okay, let's just do employer match in the 401k. And let's just do, $50 a month in my VOO, like just something simple. And then you can go from there. And like, if you never do anything more than reducing expenses, increasing income, employer match, and $50 a month into the VOO, you're already ahead of like 70% of people. Just by that bare minimum, they're already ahead. And then if, like I said, if it ends up trickling into learning something else about something else, you just keep climbing the ladder of being higher and higher. And like what you're saying about like 10%, the example of 10% a year, when you make $100 is what you're going to go to $110. Like, okay, that's not moving the needle. But when you're at $1 million, that same 10% is now $100,000. So like you're not getting any different returns. It's just the same percentage on a bigger number is a bigger number. That's how that works.
Yeah.
Which is how you were able to go, it probably took you 20 years to get to $1 million and it took you 3 years to get to 2.
Yeah, exactly.
So like I have a dividend milestone little thing that I put together on my spreadsheet that literally it's visualizing that, where it's just like, okay, it took me 864 days to get my first $100. And then it took me another 400 days to get my next $100. And then it took me 200 days. And then it took me 53 days to go to my next 100. And it just keeps progressing. And then eventually I'm just going to get a $100 dividend check, and it took me one day to go to the next $100 or whatever. So
that reminds me, there's a quote, maybe I can Google it really quick. It's talking about Warren Buffett has earned, like, I don't know what it is. After the age of 60, he's earned like 90% of his portfolio.
yeah, I looked at a bar chart that had Warren Buffett's net worth on it, and it was just like wild to see how quickly it's grown since like the last 10 years. I don't remember where, I might have saved that chart. If I did, I can put it in the video. Yeah, I don't know. It doesn't look like I have it. That's unfortunate. But yeah, it was pretty impressive. And that's just compounding. That's quite, like, Warren Buffett is successful, one, because he's smart and he knows what he's doing, but he's also successful because he's been investing for 70 years. Like, anybody that does anything for that long, like, Warren Buffett's probably forgot more about the stock market than we know.
Right. So you were saying that as you get older and your portfolio gets bigger, the average increase gets bigger and bigger. So Warren Buffett, this is according to Barron's, one of his remarkable achievements is that he's generated over 90% of his wealth since he turned 65.
Yeah. That's wild. And that's just 10% growth on billions of dollars at that point.
Yeah. And because his portfolio is so big, he's lagged the market performance recently because, his portfolio is so big. It's hard to beat the market when you kind of are the market, right?
Yeah. Yeah.
So it's not like his performance lately has been astronomical.
Yeah. Yeah. Everybody's seen and I've referenced it a couple of times in these conversations, the dividend income that he receives from like Coca-Cola alone is just insane, like $90 billion or something like that, or it might be $1 million. I don't remember what it is, but it's some ungodly amount of money that we couldn't imagine spending.
Yeah. And how long has he held Coke?
Yeah, for too long enough.
Yeah.
Okay, so last question for you. So somebody that's watching this channel has already decided that they are going to do dividend investing. They're going to be a dividend investor. What tips do you have for them from that point forward? So it can't be just get started because they've already decided to get started. So what's next? Like, what's the next tip that you have?
I would say educate yourself. Read as much as you can. So even though I started majoring in finance in college, I found out that what they teach you in finance in college is just theoretical. It's not stuff that they actually use for the most part on Wall Street. So how did I learn about investing? How have I been so successful? It's just by reading. I look at magazines. I look at books. This is before the internet. That's how old I am. And you just need to educate yourself and don't follow just the same type of source, because if you're going to get biased viewpoint. So educate yourself. There's a lot of free stuff out there in the world that you can educate yourself. And here's something too that you have to realize, that when the media is talking, like CNBC, what garners the most attention?
Fear.
It's the negative stuff. If they said that, like the forecast for next year is average, going to be average temperatures, is that going to get people to read it, to click on it? No, it's going to be, and if an article says that next year we're not expecting a recession, is that going to get many clicks? No. But if they say, it's going to be a hard recession, the recession's coming up, people are going to be laid off, lots of people click on it. So this is my wordy way of saying, no matter how scary or good the economy looks and sounds like, you need to invest regularly.
Mm-hmm.
If you're not investing regularly, you're trying to time the market, right? Do you know, Troy, how many people on the Forbes list of most wealthy people, how many of those are market timers?
Probably none of them.
Yeah. Did Warren Buffett get wealthy because of market timing? No. I mean, if someone knew how to market time, I would follow them, because you could be a billionaire and really quick, no matter how small the amount of money is you're starting. But the thing is, it's super hard to do. No one can do it consistently. Like people who predicted the Great Recession in 2008, 2009, they have got a lot of people listening to them, and their predictions now, since then, have been horrible.
Yeah, I say that all the time. That's why I don't listen to like so and so making this prediction or that prediction, because what happens is they make 1,000 predictions, they get one right, then they make 1,000 more predictions and get them all wrong. And I'm like, you are literally listening to somebody that got 1 out of 2,000 predictions right, and you think that like they might have this accredited or that accredited. Like my grandma on my mom's side did the same thing. She's listening to some dude. His name is I forget, Jim Richards, something like that. And he has some, like, he looks like he's been investing for a long time. This dude looks very, 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 very old. But like, he lists his things that he's accomplished. He's done this at the Pentagon. He's done this. He's done that. And he's done this. It took me 4 minutes of watching what this guy was talking about to know that he's nothing but he's a fear monger. That's literally all he does. He like,
or he's a perma bear.
Yeah. He like everything's bad. Buy gold and silver. The stock market's going to crash, like all kinds of stuff like that. And I'm like, I told her, I was like, hey, like to each their own, you know, do what you want with your own money. And then the craziest thing was in my YouTube feed, I have a guy that I subscribe to. I don't remember who did the video, but somebody did a video where they interviewed a guy that was basically, and okay, so two different thoughts that are the same thought. So the thing that's compelling about these perma bears or the fear mongers is they always have some kind of stats or data that they can use to back up what they're saying. There's always some kind of data, but
cherry pick.
Yeah. And so then the other thing was this video that I saw pop up in my feed. I watched it, and this guy, now mind you, I didn't search this. This was just in my subscriptions feed. So I already subscribed to this guy. And it was an investor that like just a YouTube channel, and he was talking about another investor. So I don't even subscribe to the guy that said this. But this guy was saying that he thinks that the market could more, what did he say? Go up by 50% in the next 20 years, or like 50x in the next 20 years. And his point behind that, again, backed up by data, but he was saying, look at the evolution of the stock market over the last 50 years compared to the years before, the previous 200 years before that. Like, look at the growth. Like, even when you zoom out over the last 50 years over the S&P 500, it's a hockey stick. It's really slow, and then it's exponential. And so, like, why wouldn't compound growth work the same for, like, the broader indexes? So what's to say that the S&P 500 doesn't 50x in the next 50 years? Because it just, and I sent her that video, and I'm not saying I agree or disagree with that, but like, one, it's the data. You can always find data to support almost anything. And then two, I sent that to her, and then she got frustrated, not at me, but like at the idea in general. She was like, how can this one guy say the market's going to go to crap, but everything's going to zero, and this next guy with the same market say that it's going to 50x in the next 50 years? And I was like, that's the point. Nobody knows. Buy and hold. Just keep buying. Goes down, buy more. If it goes up, buy more. Goes nowhere, buy more. Like, just keep buying. That works. It's proven to work. There's never been here's some data for you. There's never been a period of time in the last 30 years. Well, yeah, what works on Wall Street is that like here's a bunch of,
I made a few notes.
Yeah, there's a couple notes in that.
The reason I brought it up, and it's autographed too by the author. He runs, I think, $6 billion of stuff on Wall Street. The reason I bring that up is he's got like a chapter about predictions. And so they did a study on these predictions, like you said, well, is market going to go up? Market going to go down? And the accuracy percentage of the predictions were actually lower than 50%.
So flip a coin.
You'd be better if you flipped a coin, because the percentage accuracy was less than 50%.
Yeah.
So yeah, like you say, don't listen to these people that know what's going to happen in the future. No one predicted the iPhone. No one predicted streaming, you know?
Well, just look at like the top 10 holdings in the S&P 500 20 years ago. None of them are the same. I don't think any of them are the same. And like in the last 10 years, I think 1 or 2 of them are the same.
And the ones now that have been beating the market are not necessarily going to be beating the market in the future either.
Yeah. Yeah. So like, that's the thing. So like the data that I remember seeing a long time ago was like in the last 30 years, no matter what period, like what 30-year period you want to pick, 30 years consecutively, the stock market has never had a negative return. Never. In 30 years. Yeah. You can literally go from depression to depression. It's always been above.
Yeah, as long as you're diversified.
Yes.
Now, a beginner investor might say, I'm going to buy 2 stocks. So Troy said, I won't have a negative
Yeah, no. Yeah, like this is literally the return of the S&P 500.
I'm just saying this just so that new
Yeah, I agree. Yeah, so like, yeah, you can't just
diversify.
Yeah, you can't buy, IBM and AT&T and think 30 years from now you're going to be a billionaire, because that's probably not going to work. But yeah, so like that's the thing. But like in the market, so if you were to buy VOO today and hold it for 30 years, unless it's the first time in history it's ever happened, you will never have less money than you have today. Like in 30 years, you'll have more money than you have today. Like that's just how it's worked. That's going through depressions and wars and COVID and the housing market bubble and whatever you can say. It's gone through any of those 30-year periods. It's done all of them and never been a negative return. Never. So like that's all that to say, buy and hold for the long term. You'll be all right.
Yeah, but my friend said I should buy this penny stock, and it's going to go up 18,000%. Should I buy that?
Well, your friend's probably also broke, so I don't know what to tell you.
Oh, he's doing a pump and dump scheme. I think he's actually pretty rich.
Yeah, that guy. Yeah. And like that going back to what we very first talked about with like people with the high risk tolerance, or they think they have a high risk tolerance until it doesn't work. That was the catch of what everybody was drawn in on, is when you can buy Dogecoin at a fraction of a penny. And you can spend just $100 commitment to get like 2.1 million shares or whatever that comes out to. You think you're doing something. But when you own, whether you own 1 share of something or 2.1 million shares of something, if that thing you own is crap, you still own crap. Like that's what it is. Sorry. Like that's.
You can invest in a penny stock, and I could invest in a $100 stock. And if we both invest in the same dollar amount and they both go up 10%, guess what? We both made the same amount of money.
Yeah.
So it's the percentage, not the dollar price of the stock. Really, the price of the stock depends on, or matters, versus how much is that company going to earn in the future? And that's not easy to predict. So investing in stocks and choosing stocks is not easy, which, like you said, if you just buy VOO, which is 500 biggest companies in the US, you'll do pretty well over time.
Mm-hmm.
Now, in 2008, 2009, during a 12-month period, the market, in other words, VOO, was down 55%. And that's going to happen every once in a while.
Yep. And if you include that 2008, 2009 in a rolling 30-year period, still positive.
Oh, yeah, exactly.
Yep.
Exactly. So, people just need to be ready for the ups and downs.
Yep. Yeah. That's a really cool thing that we did there, not on purpose, is tying all this back into risk tolerance. That was the first thing that we talked about. So that was, I think that's a great way. I think that unless you have anything else to add, I'm ready to wrap this up. If you have anything to plug, feel free to go ahead and do that. The floor is yours.
If anyone wants to follow me, let me share my screen. Here's how you can follow me. I'm on YouTube. I'm probably going to start releasing some investment videos. Right now, it's just accounting videos. So if you have insomnia, you might want to watch my accounting videos to fall right asleep.
There you go.
You can follow me on Twitter. You can go to rexjacobsen.com, which just takes you to my my online investment newsletter, beatthestockmarket.com. Now, that's a paid service, and it's not for new investors. So if you're a new investor that wants to learn along with me, just follow my YouTube stuff, because that's going to be showing my $12.50 portfolio for free.
That's really cool. Yeah, I like that. There's a lot of different avenues to give you follows on there. Go out and support Rex for taking the time to speak with us today, to give us his wisdom. We'll definitely have to have Rex back on as he gets more free time, when he gets his fat fire going and decides to retire. We'll have Rex back on, and we can go over that $12.50 portfolio and anything else that he's progressed in and things that I've progressed in. So
just one more question for you. When do you pay me for doing this?
When do I get paid for doing this? That's my question. I don't know. Yeah. I mean, maybe your interview is going to be the one that blows it up, and we'll send you something. We'll send you a Dividend Obsession gift bag.
Accounting professor. What the hell's wrong with him?
Yeah. Yeah. So there it goes. But yeah, anyway, thank you, Rex, so much for joining us today. It's been a blast. I appreciate you taking time out of your Sunday to speak with us. And until next time.
And that concludes another insightful episode of Dividend Discussion. I hope you found inspiration and valuable takeaways from our engaging conversation. If you're hungry for more dividend investing wisdom, be sure to subscribe to Dividend Obsession and hit that notification bell to stay up to date with my latest interviews, tips, and strategies. Remember, the journey to financial independence is a marathon, not a sprint. Keep applying the lessons you've learned and stay committed to growing your wealth using dividends. Together, we can create a community of dividend investors sharing knowledge and supporting one another. If you enjoyed this episode, don't hesitate to share it with other investors that are equally passionate about the power of dividends. Let's spread our dividend obsession far and wide. But until next time, see you.